Science Finance Essentials, so preparing for investment and growth. Super happy to have James Graham and Maylene Flores. Did I say that right?
Yep.
From Richter Financial Studios is going to lead us through today of kind of some of the basics of financials, some of your accounting and management, investor-ready pro formas. How do you incorporate this in the pitch deck and kind of making it all come together? And then I'll wrap up with a few action items and a close for today. But we're really excited about this session because this is a really important one and one that, generally speaking, when I'm judging, this is a common place where people kind of fall down, which is always a disappointing place to kind of lose momentum. So important stuff today. Just as a reminder, if you could go on mute while James and Maylene are talking today. Come off mute to ask a question or enter it into the chat box, and I'll also be monitoring the chat box and jump in when they pause to solicit questions. And James said he's going to have a series of breaks through the morning where he'll pause for Q&A. Monitor the chat window, so questions, answers, comments in there. Keep your video live if you can, as a courtesy to our presenters. If you are having issues with freeze frames and connections, then go ahead and turn off your email and maybe shut off your camera, and that helps provide your bandwidth. So with that, I'm going to stop my screen share. Where did my stop screen?
All right. Maylene, do you want to pick it up in terms of share?
Let me do that.
All right.
And then I will turn it over to James.
All right. And so while Maylene's pulling that up, I'll just kind of kick off here real quick. Like as Kevin mentioned, what we're really trying to do is cover, what we consider the life science essentials, the accounting, finance, and business operation elements you need as an early stage life science company, helping to position for capital, helping really set yourself up for success as a company. And I'll share a little bit more about our company, but a little bit more about my background. I've been involved in accounting, finance, innovation for too long, and so I've been involved a lot of different roles, various CEO and CFO roles, including CEO of Richter for 20 plus years. It was also before that I was with in public accounting with Deloitte, Laventhal, doing audits, Fortune 500 and other large companies. Have been involved with a lot of different different pitch committees, like on the OEDIT Life Science Committee with a number of people like Kevin and Lisa, for example, and also involved just different pitch committees. I'm also founding member of the Bullpen, which is a kind of a new life science organization that's really neat for early stage companies, and also involved with lots of different not-for-profit causes, as well as I've also been involved as an angel investor in a number of different companies. So with that said, I'm also Boulder based, but we're Colorado, California, and so representing California, I'll turn it over to Maylene, who's in San Diego, and to take it away.
All right. Hi, everyone. Good morning. I'm really happy to be here. I appreciate the opportunity to help lead parts of the program today. Sorry, Kevin, I was on mute, but I was going to say it's pronounced Maylene. So Maylene Flores, I'm a CPA. I'm licensed both in California and Colorado, and I'm a partner with Richter Financial Studio. Sorry, I'm starting to get a little bit of a cold, so I'll be having cough drops throughout the session, and my voice might be going in and out today. My background is I've provided strategic financial leadership in various roles, such as serving as a CFO, director of finance, and controller for a number of life sciences and innovation companies. I also have experience working with companies in helping them understand and manage their government grants and contracts, and helping them to ensure that they're in compliance and optimizing their funding. As a capital strategist, and I'm here in California, as James mentioned, I'm on Biocom's Capital Development Committee. Biocom is essentially similar to CBSA for those of you in Colorado. It's our California Association for Life Sciences, and our Capital Development Committee. We look to connect companies with sources of funding, both dilutive and non-dilutive. And then I work with different life science companies. And so I also regularly attend board meetings and help companies with strategic financial guidance, supporting their growth and innovation. And in my free time, I also support the innovation community by serving as a mentor to students and startups. I work with different universities, incubators, and accelerators. I look forward to sharing my financial wisdom with you all today throughout today's program. And I'll turn it back over to James.
All right. So yeah, also some more real quick context. Yeah, we have a team of roughly 30. We're Colorado, California based. We have clients throughout the US as well as internationally. But we basically just focus on working with clients in a few different verticals. Maybe push the slides ahead a little bit, Mylene. And we basically just focus on working one more. So we basically just focus on working with companies in just a few different sectors. Life science is our number one sector. We also work with companies, aerospace, defense, as well as government grants and contracts. And then there's a little bit of a catch-all with there's companies that can be really good fits, the deep tech area. We have a good handful of AI firms, including one who had a nice exit, who also interested in quantum clean tech. So anyway, one other thing I'd say is we also it's not less of a vertical focus, but more of a specialty. We're very strong with government grants and contracts. So a lot of our clients have, early stage, they have non-dilutive funding through, very often through grants, and then quite often there's also opportunities to have, non-dilutive funding through different government contracts. And particularly if it gets into, the DoD realm, that can get, be pretty significant in terms of the funding sources. So anyway, so that's kind of our focus areas. And then also one more, we also tend to work with, essentially what we've done is we've built our core service offerings around the needs of our early stage life science companies. And so we're helping with a lot of the things we're going to be talking about today. We're accounting, fractional CFO, government grants and contracts, budgeting and forecasting, helping plan and build the right tech ecosystem so the company can operate efficiently. We're helping with the setting up the payroll, the compliance, the benefits, HR guidance, helping companies position for capital along their journey. And we'll get into that in a lot more depth. Making sure they take advantage of R&D tax credits and opportunities, helping with manage their cash flow, and then also addressing, as audits come up, whether they're GAAP audits or SBIR, or DoD type audits, we're helping them along the way. But like I said, most of our, probably more than half our client base is life science. So a lot of what we do is, one more slide. We live quite a bit in the life science ecosystem. So we're involved in a ton of different organizations in different ways. And I think that's, one thing I'd throw in. A lot of the companies I see doing really well and moving forward are really deep in the ecosystems. So, going to, essentially getting out there and pitching and connecting with investors, getting feedback on what they're doing along the way. And there's a lot of different places to do that. With CLS, we help them develop their CLS fast incubator. With Biocom, or Mylene's in the Capital Development Committee, and we're involved with them with other things. Colorado Bioscience, we were involved with the recent Life Science Night just recently, as well as the collaboration they have with Rockies, helping with that a little bit. Just a lot of other organizations. I won't go through all of them, but just, yeah, trying to essentially be, very deep in the ecosystem. So we really learn a lot and connect, with the companies. And so we're better informed of, how to help them with the journey and also where opportunities are. Because we're often, whenever we can, we're pointing our clients to opportunities. So anyway, with that said, in terms of intro, kind of review at a high level, what we're going to be covering today. Moving ahead, Mylene. We're going to be, as Kevin mentioned, we're going to be talking about positioning for capital. We're going to be getting into, essentially what that means is how do you really get set? You don't essentially just do a pitch and expect money to come. There's a whole process and a whole framework involved with how you approach getting ready, to receive funding. It's very much very much a process, and with a lot of elements. Also with financial statements, we're going to be doing an introduction to financials. We're going to be talking about, difference between cash and accrual basis. When do you switch from cash to accrual? The differences between generally accepted accounting principles versus SBIR grants versus government contracts in terms of the accounting related to that. Also, we'll be touching on, the grant accounting management. How do you optimize the accounting and management of the non-diluting funding when you get that? Whether it's, the SBIRs, OEDITs, GATES, all sorts of different, grants and contracts that are out there. And then also, in terms of, the cost proposal basics, we're going to dive into that a little bit because that's often the first stage of what you're looking at, of how you approach preparing your cost proposals. And then we're going to move forward into talking about preparing investor-ready pro formas, because that's a really critical element, kind of a linchpin of, partly understanding your business, but also being able to communicate to investors and really pull your whole story together in the numbers. It's kind of think of it as the complement to the pitch deck. The pitch deck is almost the story. The investor-ready pro formas it's a story, but it's more in the numbers and the details of how you're going to do it. We're also going to talk about some, financial elements of pitch decks, and then we're going to talk about how to make it all come together in terms of moving forward, and then, wrap up. Couple other things, we're going to be covering a lot of ground. So I think, some of this may be basic to some of you, some people out there. Some of it may just be quite a bit. We will be providing the slide deck afterwards, so don't feel you have to capture anything that's, on the slides here. We are also going to try to take a lot of different brief breaks after the different sections, so everyone can get their questions answered, and we can hopefully answer a lot of the questions along the way. So we're going to be covering a lot of ground, so don't feel we want to provide a lot of good info, but we also don't want to overwhelm. So hopefully we can strike that balance. So. All right, with that said, we'll jump into very high level of positioning for capital. So the one thing I'd like to start with is just a very high level. You guys have seen different versions of this. This is not like the one way that sums it up, but this is just a way to kind of think about how funding happens. The reason I mention it is, one is, it's important to consider where you're at in the journey, but it's also always important to be starting to think about what's your next step in the journey, because you almost have to be kind of dual tasking between addressing the current needs as well as planning for the next steps. But so if each company is going to have a little bit of a different approach, but there are some themes that are often there. Often early stage with therapeutics, there's kind of the angel, then moving into pre-seed, seed, Series A, Series B, as I'm sure you've heard about. It's different between companies. We just kind of laid out some, possible pathways, for example, therapeutics and digital health companies here. And the angel stage, with the, or even a friends and family, you might be working on, being involved in some accelerators, rounding out your company, getting involved, with getting the R&D, getting some, in vitro data. Data increasingly is becoming, one of the elements that investors are looking for. The pre-seed, you may be getting in, maybe designs, you're getting into the R&D, little maybe in vivo data. The seed stage, you may be getting into the a little more R&D, animal data. You'd be getting really clear on what indication is going to be your primary focus. What might be secondary indications you can consider down the road. Series A, the IND submission, getting into phase 1, 2 clinical trials, and then Series B, you may be getting into kind of further along the FDA process and phase 2, 3 clinical trials and so forth. And it's similar for digital health. I won't go, kind of essentially proof of concept, making sure you have right product market fit, going to market, et cetera. So in a sense, the important thing to really know is, based upon where you stand, what is what's the focus for, what is the typical journey? What is it that investors are going to be expecting for the industry that you're in, and the stage that you're in? What are they going to be looking for? So educating yourself on that, you're in a great place to do it, being in, to get feedback, being in the Innosphere Accelerator, and essentially look to just also get take a lot of feedback, as you're moving along the journey, because a lot of people are willing to share information, and a lot of that information, rather than trying to make sure you're always just explaining it and kind of batting it away, trying to also, while you want to answer questions that are coming your way, you also want to make sure you're really receptive and taking it in, and using that to move down the line. But essentially, each of the points are going to be looking to demonstrate to investors how you're going to create value inflection points that are going to be able to lead to the next funding round, or possibly eventually down to an exit eventually. So next one. And then the other, also at a very high level, I wanted to touch on attributes of a fundable startup, but particularly I want to touch on it from the point of view of how this is relevant to finance. So this is, there's different variations on how this is presented. What is it that makes a startup fundable? And we could break it down into these 4 elements. One of them is market. So client, or you have to really know your market, whether it's therapeutics, digital health, et cetera. You need to understand how how the product market fit is going to be there, where your opportunity is, where your differentiator is. You have to understand your competitors. That's often one thing I hear is when reviewing pitches, and people are just making too light of how the competition, and thinking it's nothing, and we're really unique. But really understand your competition and how you're different, and how you are able to kind of bring something that's going to be really different, and therefore fundable. But also, how is it going to bring value? What's your pricing approach, and so forth. But in a nutshell, another way to think of it is, with your market, that's one of the elements you need to build into your pro forma. You have to be able to demonstrate, how you're going to be able to bring value over time. How you have to demonstrate that in numbers. You have to do it in your pitch deck, but you also have to do that in your pro forma. And then, jumping over to team, you also have to be able to, as you probably understand, have a really, really solid team. You have to have, any employees, advisors, your board of advisors, different consultants, but trying to put together your team over time. Increasingly, you have to have more and more needs addressed. And ultimately, you have to have enough of a team that's going to allow you to be able to deliver on the promise of, the R&D, that you're, pursuing, and maybe translating that into, a drug, medical device, et cetera. And then also having the ability to, hire and retain the right people. It's one thing to get people, it's another thing to keep them. But all of this is also a very important part of what's going to go into your pro forma, because you're going to have to, really demonstrate an order of, what your plan is and who's coming in next and how we're going to pay for them. And typically most pro formas have a people page to it, and that demonstrates how you're going to, how you're going to bring people in. Are you realistic and what you're going to be able to, what you're going to pay them in terms of, comp, in terms of stock options, et cetera. And then the next is, we call it, I don't know, call it the product, or you could call it service and tech. But essentially, obviously, your tech and what you're bringing to market has to be solid, because if it isn't, then there's only so much that that can happen out there. And you also have to have to be able to demonstrate how you plan to, what your plans are in order to create that product over time. It ties in with the team, but it also might tie in with how you're going to be spending. You may be doing research through a CRO. You may be bringing your possibly moving into manufacturing, as some of our clients have done. You have to just look at, how do you describe that in the pro formas. And then finally, the capital plan, which is kind of, really how you pull all the finances together. The investor ready pro forma, like we were talking about, is kind of the, ultimately connected with the others, but it's a thing of sorts in itself. How do you pull together the funding? How do you pull together, the spend? How do you pull all these elements together to reach those value inflection points in a way that's really cohesive and makes sense? So that, that's essentially, that's enough on that kind of high level. And also, just to have one more high level area to talk about, it's the stages of the deal. And so very, very high level, there's almost, if you're going for dilutive funding, there's really two high levels of what you're trying to do. At stage one, you're trying to get a term sheet. You have to target the right investors. You have to, have the investor, pitch decks often targeted by investor profile, and just ultimately, are you doing a 5-minute pitch, or are you doing a deep dive in a data room for a strategic to possibly be investing in? You have to have pro forma financial model, at least as a starting point. And it often helps to ahead of time to pre-assemble a data room so you're ready if once you get a term sheet. And then in the next stage, you're often, negotiating a term sheet. You want to have a sense of where that's at. You want to, refine your data room so it's ready to go to provide information, and also just so you look really sharp and you look ready and you look like you belong. You're ready for funding, so to speak. A lot of key elements there are kind of having your financial and compliance elements, along with everything else that's part of the data room. The science, your IP information and so forth. And then the other thing I'd say about closing the deal, it's really, really key to get your advisors involved, because closing, not many people are involved in closing deals every day, and so it's not something you're going to probably have been involved with regularly. So getting your advisors, your particularly M&A attorneys, getting, people with Innosphere and other groups, trying to get the right people involved. And so, I talked a little bit about the stages of the deal. We talked about, that's kind of the dilutive funding approach, but I also, there's a great deal that he said about all sorts of other ways to get funding. There's the non-dilutive route, and so you can get OED. It's a great, lots of companies that do well, go through the, Colorado OEDITS program, and that's often you can combine that, the match they need with the SBIR funding, and that's really common for companies to get multiple NIH, NSF, and others. There's also some, pretty significant funding out there through, other organizations. It really depends on your area of specialty. It's going to be very different if it's, if it's cancer or malarial drugs, for example, like Gates Foundation is a great one. If you're, addressing something like malarial drugs, there's all sorts of cancer organizations. So there's all sorts of funding out there for, and then also, help the accelerators go a long way towards helping open those doors also, because even being involved in a prestigious accelerator is something people on pitch committees are going to be looking at. And it's also going to allow you to have connections and the support and so forth. The other I'd say is other things you can look at is, R&D contracts from future customers, later phase trials, doing clinical trials with strategics can be really powerful. Partly you could possibly be, courting an acquisition partner. You can get prototyping sometimes. Occasionally, if the right fundamentals are there, you can get conventional funding and so forth. But anyway, so that's a lot said, but that's I think what we'll probably do is move to a quick Q&A, because we have a kind of lot of ground to cover, but wanted to allow a little bit of time for any questions anyone might have for Mylene and I, with a quick pause there.
Hey, James, I see one question in the chat.
Okay.
How do companies decide to do Series A-1, A-2, etc.?
All right. Well, a little bit. Yeah, some of it ties in with economics. Sometimes the economy's moving slower, and they kind of do a partial funding round. But they have enough, and they want to pull that money in, is one of the key reasons I see there. But they, the market economics may be changing, so it may be somewhat similar. A little bit is somewhat arbitrary. There isn't a, it's a little bit of an alphabet soup in terms of there's some general approaches in terms of how people do this, but sometimes people say A1 and A2, and then they sometimes combine those and they just make it a single A round. So there's all sort, and it even goes back further. Sometimes they may have a multiple rounds, and then they compress it into one round. So there's all sorts of things that happen, but it's usually driven by the pragmatics and often the cash needs of the company as they're moving along, at least in my experience. So,
Hi, James, this is Joey here.
Hey, Joey.
You started talking about things like pro formas and stuff like that, and I want to make sure at some point in time you actually define these. I think some of the people here would really be
okay. Yep.
grateful to understand this before you get into sort of the depth of the different kind of accounting structures. I think they need to go back a step and understand some of those things.
Right. Yeah, we're gonna do a deep dive into pro forma, starting with talking about what they are. But let me, since you bring that up, let me just say pro formas are proformas is a term. It's kind of projections is another term. We like to refer to investor ready pro formas for the types of, the type of forecasts that we're doing. There's a lot of different types of forecasts, and we'll get into that. But pro formas are kind of a future looking, it translate, I think it translates of a type of form or something like that, but I think of it as an as if scenario. And so you're building out an as if scenario into the future, and it's typically based upon financial statements. So one, just as we look ahead presentation wise, we're going to talk about what financial statements are, and then it's essentially projecting financial statements into the future to show financially, where the company is going from a financial perspective. All right. Any other questions?
So I had a question I was typing in, but I can speak now. So I am using spreadsheets for things like my budget and pro forma,
Uh-huh.
except my books are kept in like proper accounting software. But I was just kind of wondering what tools you recommend besides spreadsheets. Spreadsheets are free and other tools are not, but are spreadsheets fine at this stage? And what should we go to? What we should be thinking of going to?
Yeah. Yeah, I love it. Everyone, we're jumping ahead to another section of Proformas, but
I can wait.
yeah, no worries. Yeah, we have a section and kind of how you build it, so to speak, but I can answer it at a high level. Essentially, yeah, Excel's kind of the Swiss Army knife of business. It can just be used for all sorts of different things, and it's amazing, but it's also limiting, like the Swiss Army knife. And so, what it depends upon your context. Earlier stage, they can be helpful. And sometimes it can be helpful to turn it over to someone that's able to actually take it further. A little bit depends upon your bandwidth, sophistication, and so forth. It often helps to get assistance with building Proformas. Like we use software, but I couldn't recommend it for most people because it'd be way too complex. It's kind of there's a pretty significant learning curve, and it's basically building out, balance sheet, income statement of cash flows in a way that's integrated with the financials. And so you're not just typically what people are doing, and we're going to get into this in terms of different approaches to, forecasting and how things are framed. But yeah, it's often pretty limiting. It's real easy to break break formulas. As they get big, it gets increasingly hard. When you start getting, 5, 10, different tabs and a lot of complexity, they get increasingly cumbersome and time consuming to manage. And it's also really hard if you're really trying to do a true balance sheet and income statement and cash flows and have them all connected and keep that all from breaking. So great for the start, great for putting ideas together. Definitely at a certain point, you're going to want to have proper, certainly as you get into, ideally as like an A round, you're going to have some more in-depth forecasts, and also ones that can connect with the accounting system, so then you can more readily do budget versus actual, for example. But we will be diving deeper there.
Thanks.
All right. Anything else before Mylene picks it up?
Nope, nothing else in the chat.
All right. Mylene, I think it's you. I should look. Hope it's
Actually,
you.
James,
Is it me?
I'm gonna keep it with you.
Oh, okay. Sorry. All right, you're right. Okay, you guys have to listen to me a little bit longer here. So, all right, so we're gonna jump into Financial Statements 101. Is a little bit what we were touching on. So this is this is an area, unless we're gonna touch this. Don't feel that this is going to be an area, at the end, we're going to talk about the pulling it all together, but a lot of people didn't go into accounting for a reason. And so it's that said, it's important for you to understand, some of the basics of financial statements, even if you're not dealing with them yourself. And so we've also tried to put, a fair amount of detail in these slides at a high level, so you'll be able to use these as a reference as you move forward. But I think a simple way to say it is, financial statements are essentially showing the results of what you're doing with your business. There's, at a very high level, there's 3 main financial statements, 2 of which, basically being the balance sheet, the income statement, sometimes also known as the P&L, or profit and loss, and then there is the statement of cash flows. Sometimes companies are just using a balance sheet and income statement. But in a sense, the details of accounting can be hard to get, just because it's a nuance, and there's a reason people go to school and kind of it's a lot of some of it is kind of gets theoretical, so it kind of bounces off people in terms of understanding the 3D nature of it sometimes. But the simple thing I'd say is that let's look at a balance sheet. You know, one thing to understand is you know, that, you know, typically at the top of a balance sheet's the company name. And then you also have, you know, it's the basis of accounting is often has to be clear. Some are cash basis and accrual basis. And this is where I know I'm going to have some people kind of glazing over at this point. So I just say take in what you can, because, you know, this is where it comes over time, some of this stuff. You know, we have a lot of, you know, CEOs that kind of learn, increase, you know, it adds up over time the more you hear different things. But basically the balance sheet is, yeah, it's trying to, you'll notice it says as of December 31st, 23. So it's a snapshot at a certain place and time. And you can almost translate it to your personal finances a little bit. You know, you might have assets like a house, a car. In this case, a business has cash, it has accounts receivable, it has inventory, you know, and then it's separated between a current assets, which are generally assets which are useful within a year, and non-current, which are, you know, used over a longer period, like property, plant, and equipment, or intangible assets, which are like intellectual property and so forth. And then, you know, there's the asset section. The next section is, you know, there's you know, so that the total of the assets in this case is 520,000. And then you'll notice the liabilities, they're also kind of similar, and there's roughly two sections. There's current liabilities and there's, you know, non-current or long-term liabilities. Current liabilities are those elements that are expected to be essentially used or paid within a year. Accounts payable, you know, accrued expenses, which is kind of one of those accounting concepts tied in with accrual accounting. It's there's also short-term debt you're going to be paying in within a year. And then there may be long-term liabilities, like long-term debt that may be there. And so notice that the total liabilities there is 190. And the other one is the equity section. So I should also just continue the analogy. Liabilities are like you might owe money on a mortgage, on a car, etc. Those are the types of things that would go in here. You owe a certain amount at a certain point in time, like the end of the year, for example. And then the next piece is the equity. And then this is where, you know, and it is actually quite an important, you know, it's kind of can be very complex, but it's a very important element related to early stage companies, because this ultimately is where, you know, this can show that, you know, the liquidity, the financial health of a company. You know, this is where ultimately the ownership is kept, you know, so there's common stock, which is quite often owned by the owners of the company, early stage founders. You know, there's the preferred stock, which is often owned by the, you know, by the investors that are coming in. There's also additional paid-in capital, which is, you know, another concept, additional money. I'll leave that one actually. And then there's retained earnings, which is, you know, how much money after, you know, has been accumulated over time, you know, in the company. But another way to think of it is that, you know, all the current assets equal the amount of liabilities plus also the, you know, kind of the accrued value of sorts in the company. You know, it's not necessarily market value, but it's kind of the, you know, kind of the liquidity, at least on an accounting basis in the company. So that's a balance sheet. That's a, you know, accrual basis in this case, and it's as of a certain date and time. And so we'll go to the next financial statement, which is actually this is for one company. I was just having fun with the titles here using ChatGPT. So Genie. Anyway, that's a song reference, but BioBuzz is my next company here. But anyway, so this is the income statement basically shows, you know, how much you know, how profitable is a company over a period of time? So this is like for the whole year. And so this also intuitively probably makes sense with your own finances. How much revenue am I going to bring in over the course of a year? Kind of that ties in with the sales revenue. This is where you also might put your, if you receive grant money for, that would come in here. The investor money goes on that other one, the balance sheet. But if you receive grant money, it comes into as income. You might have cost of sales if you have commercial revenue. So you have you know, so the sales, you know, versus cost of sales, a really key concept to understand, because a lot of people are going to refer to this as gross profit, or it's also referred to as gross margin. And so, you know, people are often asking what's your gross profit or gross margin percentage. So this is a good one to know. Then the next, you know, then you have your various operating expenses. R&D expenses are a key one. The general and administrative expenses, there's usually a lot of different elements there. If you have sales and marketing, and that makes up your operating expenses. And if you take your gross profit minus your operating expenses, you have your operating income. And then next up are these kind of less frequent types of items, you know, like interest expense down here at the as well as interest income, and there's some other types of other income and expense items. But in a nutshell, it's those kind of elements that aren't you know, directly related to the operations. And so once you take those elements away, you get net income before taxes. You might, you know, if you have income, you know, if you have income, you might have some income tax expense. And so then you end up with net income at the bottom. And then the one thing I say I didn't add here, but sometimes you also might hear the term EBITDA, which is earnings before interest, interest taxes. I think it's interest, interest depreciation, and amortization. So essentially it's pulling out a lot of the non-cash, you know, elements. And so that's often a key number that, you know, is referred to, you know, and is sometimes at the bottom. But essentially you use this as the overall, you know, kind of vision of how are we doing here, but it's for a period. And then the last one, a little less commonly used, but it's a very much one of the other core components, and it's also for a period of time, is really tracking the cash flow. And you know, there's different ways to do this, but it typically starts with net income at the top. You're adjusting for depreciation, which isn't immediately affecting cash. There's other elements that are affecting cash. If your you know, accounts receivable is increasing, or inventory or accounts payable are increasing or decreasing, that essentially is putting cash in or taking cash out of the business. And so that will give you the net cash provided by operating activities. Then you might have various investing activities, you know, such as purchasing equipment. And you also might have financing activities. In other words, you receive funding, you know, from outside parties. You might have some, you know, debt that you add or debt that you are paying off, and so forth. So these various elements all add up to, you know, you added the income, you have these various activities during the year that are somewhat separate from income, and that leads to a net increase in cash. You combine that with the cash at the beginning of the year, and then you're showing cash at the end of the year. So anyway, that is very, very high, kind of a high level version of the three basic financial statements. We'll go through them again. The balance sheet, which is a snapshot in time. You want to click back? I click back. Sorry, I'm on a different deck here, Mylene. Can you go back to the balance sheet real quick? Sorry. Forgot I wasn't controlling the slides. So yeah, the balance sheet there, which is a snapshot in time. The income statement, which is over a period of time. and then also the cash flow, which is also over a period of time, just measuring different things as you move along. So, and with that said, I'm going to dive a little deep. Now, this is where I don't want people to feel overwhelmed, because this takes a while for people to kind of get it. And even people, there's a lot of CEOs that kind of get this, but it still is a bit amorphous. But it is important to understand, what accrual and cash basis financial statements are as you move forward. And I guess I'll a little bit talk about these a little bit in, kind of reverse order, because I think cash basis is much more intuitive because we're all used to that. Because that's how we generally operate our personal lives. In other words, we recognize revenue when we receive cash, and we recognize expenses when we pay the cash out. So it's very intuitive. A great advantage, it's simple, it's easier to deal with it, when you particularly have a simple situation where businesses and so forth. And early on it can be helpful to use, but it doesn't allow for what you may have heard of GAAP, or generally accepted accounting principles, that investors are looking for when you move further down the road. And I'll contrast that with the accrual basis of accounting, and it gets a little amorphous. So, but the idea here is you're recognizing revenue when it's earned, and expenses when they're incurred, regardless of when the cash is paid or received. In other words, in December, I may receive $12,000 of cash actually, let's say January. Sorry, I may receive $12,000 of cash in January for a service that I need to deliver over the course of the year. If you receive $12,000 in January and you're on the cash basis, you'd say, I have $12,000 in January. I'm rich. But if you're on an accrual basis, you recognize, I'm not really earning all of that money this month. I have to provide these services over 12 months. And so what you do then is you'd spread $1,000 every month, and you say, okay, actually on an accrual basis, I only have $1,000 of income in January. And the other months I also have 1,000 because I have to deliver. But essentially that's a real simple way to think of how accrual basis compares to cash basis. It's similar with cost, it's similar with expenses, but what it's looking to do is kind of match the true earnings versus the true expense, when expenses are due. It's if you pay for something, for 2 years of insurance under a cash basis, it's an expense, at the time you pay it, and if under accrual basis, you spread it out over the period of time. So what it does, so that points to the key advantage. It ultimately gives a better view of where the company's health is, and particularly when you're looking at what liabilities are and assets, it can provide a much more comprehensive picture. And so, or put another way, companies can get really blindsided if they're using cash basis and they have all these liabilities out there that they're not accounting for. And then lots of businesses have gone under, essentially not understanding what their true income and earnings is about. So, so another way to say it, accrual basis is required for, as you move down, because that's what investors are going to be expecting. And then one more slide, and this I'm going to move ahead a couple, but talking about the difference between cash and accrual financial statements. This is here. There's a lot of detail here. I don't expect you to follow all this, but this is a little bit something that you can reference that as you move forward. But the timing, this gets into the timing of revenue recognition. I mentioned that, I talked about the timing of revenue and expense recognition, that it's, recognizing the timing difference, the financial accuracy, essentially accrual basis provides a much more accurate picture of the company's finances. And you can be really blindsided if you're, you may think you're, cash rich, and then all of a sudden when you actually, all your expenses happen, you're out of business. The downside of the accrual basis, it's more complex, requires a little bit more. There's more details that are required in order to manage an accrual basis. In terms of the compliance standards, accrual basis is a foundation of, GAAP accounting, generally accepted accounting principles, which is you'll hear GAAP, or, generally you hear the term GAAP. So it's good to know what that term means. You may also hear the term IFRS, or the International Financial Reporting Standards, and that's often used when you have international companies. We sometimes see that when we have particularly of a large parent company in Asia or Europe, and a lot of the world uses, outside the US uses the IFRS approach. So it's fairly similar to GAAP, but there are some differences, but it's just important to know about that. And then the last thing I'll say about, in terms of the impact on the financials, that last column is under the accrual basis. It reflects all the assets and liabilities that are out there. So it's not under cash basis, you might be ignoring assets and liabilities that are out there. You're just looking at how the cash is flowing. And the cash basis, while it's simple, can be very limiting. And so to jump ahead one more slide before I jump to a Q&A here is the kind of a question a lot of people ask is, especially early stage, they're trying to get their finances together. When do you need to switch from cash to accrual basis? One key one is, your business is getting more complex. There's more transactions. You need to match. It really helps to have more matching of revenue and expenses to understand what's going on. You may need to comply with accounting standards for different reasons. Some companies are required to have audits and so forth. You may have a Department of Defense contract or something, and they may want that the books on a GAAP basis, or actually it's a little bit different. Mylene will go over that. And also, if you're looking, a really, common case here in this room is, investors or loans. The investors are going to be looking for accurate financial information. They don't want to be blindsided, so they're going to want GAAP financials. Also, if you have significant, receivables, payables, inventory, those types of things, it will really distort your financials if you're, to the extreme, if you're on a cash basis. If you need to, match revenue expenses to have accurate profitability, kind of a similar way of saying the same thing. And then also, if you're also preparing to expand and get, your business is, kind of tied in with number one, your business is getting more complex. But with that said, I thought we'd pause there and see if there's any questions that we can answer related to financial statements or accrual-based accounting, and et cetera. Okay, it's always a spellbinding topic, I know. Well, it's an accrual world out there, guys. Just don't know how to tell you another way.
Hey, James,
Yes.
I got a question in the chat.
Okay.
Would a company typically need accrual accounting if it receives SBIR as TTR government grants?
Mylene, you want to take it away?
Yeah, I'll take that one. So yes, companies will need to prepare their financials in accrual basis. It's one of the requirements. And I'm going to get into that a bit more so that we can talk about the differences and what's required there. But yes, that is the short answer.
Yeah, it's great because you guys are like one slide ahead of us. And so it's kind of the next slide is going to dive deeper there, but it's a great question because it's a real common question I think a lot of people have.
All right, here's another one in chat. Can we include issued patents as non-current intangible asset on our balance sheets? If so, how do companies do that?
Yeah,
Sorry.
that's a good question too.
Yeah.
I could take that one. So if your patents are issued and it's actually creating a value for the company, you could record it as an intangible asset. But if the patents are still being worked on and you're paying more fees and filings, you would expense those on GAAP basis as the expenses are incurred, and you wouldn't put that on your balance sheet just yet. But if they're issued, yes, if there's value there. Does that answer the question?
Jake, did that answer your question?
Okay. I just saw the chat. Okay.
Yeah.
Hi, Mylene. Sorry.
But yeah, it's a common line item, you know, the intent, it's one of the, it's a long-term assets. And then got a little more technical, you know, IP often has a life to it, so then it's amortized. So it's then, if it has a life to it, it might be expensed over time.
Hi, sorry, Mylene. Just to follow up on that question, because most of us probably are licensing out the IP from
Mhm.
universities, and we do have a milestone to pay back. So in that situation, even this issued, it's still a liability to me. It's not really, I mean, to me, it's not truly a.
Yes, if there is a liability for you to pay a licensing fee and it's something that you pay for annually, you could work to have that liability on the books if you know that you haven't paid it yet, but it's coming up due. So that would be on GAAP basis, that would be a liability to assess how much is it, can we estimate it, and should it be presented as a liability because we know it's coming and we haven't paid it yet.
But the other, so that touches on part of it, but that's a little bit of accounting that people kind of, there's two sides to transactions, you know, there's of every transaction. And so it's, you know, so there you can have you have an asset you're acquiring and you have the liability to pay it off. So it's kind of like quantum entanglement, only different. So it's like two sides of this. It's like Kevin's rolling his eyes. Anyway, so yeah, so there's two sides to every transaction. Anyway, sorry. So anyway, so yeah, so you have a liability, but you also can have an asset you're creating in the same transaction. But
Yeah, so that is interesting. But in that case, I guess is it common to like divide your potential asset by annual or whatever the life span left for the patent, and then deduct the liability annually to generate your asset sheets. Is that the right?
yeah, we're very much looking at the specifics of the situation. You know, what is the nature of the IP? Is it, you know, is it truly an owned asset? What has gone into it? You know, is it just cash out? Is there also labor going in we need to allocate? You know, what's the stage of approval? So it gets very much into the specifics of the situation to be able to determine that.
So I guess that's where your service could conveniently kick in then.
Yeah, I mean, a bunch of the areas we're kind of going over do get more technical depending upon the specifics. So,
All right, thank you.
yeah.
James, it's Lisa. I'd like to ask a follow-on question
Uh-huh.
to Xi's
Yep.
question. So these companies that are licensing out technology, let's say from CU, there's a hybrid approach, right? If they have an exclusive license, is that an asset that goes on the asset side of things, even though they may have to not necessarily pay a licensing fee annually, but let's say they have to pay a royalty ones or milestones in the future. Does the exclusive license piece get onto the asset side? And is that something that you help with, or does a business valuation person help with the value of that exclusive license?
Right. So one thing to understand about financial statements is it's not, it's usually not about the value of something. Like when you see a balance sheet, it's not the equity section isn't the value of the company. It's really about the historical costs. Now, sometimes value comes in when you're marking different assets down, but generally assets aren't marked up to value. And so we're looking at how the transaction in terms of the expenses, et cetera, are tracked. So yeah, a company may be worth, have an equity of almost zero, but it may be worth, $100 million because of IP. That's just, and so don't think of, financial statements as excuse me, trying to track the true market value of the company. It's historical costs. And each of these, IP situations, we have to look at more closely to look at really the fundamentals, because they're not all the same. So.
Thanks.
All right. Anything else on
No,
any?
we're caught up in the chat.
Okay. All right. Very good.
Great.
So, excellent. Well, we're gonna turn ahead, and so Myleen's gonna dive in. That was a great kind of segue question we had, but she's gonna talk about GAAP, SBIR grants, and government contracts.
All right, thanks, James. So James just covered the different types of financial statements, and a lot of what he was talking about was around cash versus accrual. And when you talk about accrual, that's really talking about usually GAAP. And so I put it up here as a just clarification. GAAP, GAAP, is generally accepted accounting principles. But as the founders of your companies, we wanted to share some additional reporting that you really should be aware of, as most of you, I believe, are life science companies in today's program. And so there are high chances that most of you may be looking at getting an SBIR, or you might already have one. You may also be looking at getting defense contracts, DoD contracts, or other maybe DOE, DITRA, CEPI. There might be other things that you're looking at as well that are beyond SBIR. And when you look at these other types of funding that comes in, you may also have other reporting requirements, and they are actually different from GAAP. And so I have this chart here. I know it's a lot of text, but I wanted to put it in here. So if you're reading through the slides in a couple months and you want to remember the differences, this will hopefully prompt some things for you to remember. So I have here regulatory body, and I'll go through each one, purpose, reporting requirements, and then what the focus is. So for GAAP, the Financial Accounting Standards Board, also known as FASB, is the regulatory body. And the purpose of having GAAP is for a standard accounting framework. And so that if you're comparing financials between different types of companies, there's consistency and comparability. And there are a lot of accounting policies and regulations out there that you may start to hear now that you're a founder of a company, like ASC 606, ASC 842. I don't expect you to know what these are, but just be aware that there are really specific accounting guidelines on how your company needs to report things. And it all is in the generally accepted accounting principles, and these ASC is accounting standards codification. And so just so that you know, 606 has to do with revenue recognition, 842 has to do with leases, and there are usually your first lease is your office lease. And so believe it or not, you have some really important accounting guidelines you have to follow on how you even record your lease on your financial statements. It's no longer, I pay my rent and I put it as rent expense. That's not how you would record for it. So having somebody really help you understand what your GAAP requirements are is important. The reporting requirements are usually simple enough as having a standard accounting system. So if you have QuickBooks Online, you usually can get your financials into GAAP. GAAP guidelines. You can't probably do full GAAP, but GAAP guidelines. And the financial statements, as James had mentioned, are balance sheet, income statement, statement of cash flows. And the focus again is it's really on measurement and timing. And so James went through that quite a lot. Now, when you get to an SBIR,
In my leading? Yeah,
yes.
just a quick question before you jump down this column in the chat is, can
Yeah.
we assume that SBIR and STTR are the same for this conversation?
Yes, they usually have similar guidelines. And so the reason why they may be similar is the regulatory body may be different. And so STTRs, they do have sometimes different guidelines on certain things like can you get a fee on your STTR versus SBIR? That's usually your profit, and usually not on an STTR, but regarding accrual basis, they're the same. They both need to be on accrual basis, for example. But the awarding agency, they may have different guidelines. So an example is NIH, NSF, they both issue out SBIRs and SCTRs, but the guidelines they have may be different. And so I have here just an example. I'm going to put up on the screen. This is the NIH grants policy statement. And so this is on their website, and there's really specific requirements that they follow. And NSF has their own. And so just because you have an SBIR, they're not all exactly the same. I've even worked with companies who have SBIRs with DoD and SBIRs with DOE and SBIRs with NASA. And they're all SBIRs, but they all operate differently because they're different awarding agencies.
Actually, one tiny add to that is, the STTRs are typically, you might be tied in with the university or something. So you do have to, they may have some extra requirements you need to consider. So.
Yes, that's true. And they may be more limiting if you have a STTR versus an SBIR. At the base of all of the SBIRs is usually the Federal Acquisition Regulation. And you'll notice this, it's called FAR. It also applies to DoD contracts as well. But the FAR, how it differs from GAAP is it's really focused on is a cost allowable or unallowable? Can you charge it to the grant or can you not charge it to the grant? And so a company can spend on different expenses. A common one I'll go into later is advertising, for example. A company can have advertising expense under GAAP, but with an SBIR or DoD, that advertising cost would be considered unallowable. So you can still have it as a business expense, but you can't charge it to your grant as a cost that you're going to get reimbursed for. So that's an example of what the FAR is doing. The purpose for SBIR reporting is they're really focused on your fiduciary management. You're getting federal grant funding, and they want to make sure that you're following the compliance. They're really focused on, do you have policies and procedures on how you're spending this money? Do you have safeguards in place to determine, how did you determine if this cost could be charged to the grant or not? So they rely on your financials to be GAAP in that, are you reporting it appropriately in the right period? But then they take it a step further and they want to know, are you managing these funds per what the award says? And so when you get your notice of award, there is different clauses in there and you have to read through and see what clauses are in there. And there's a lot of different codes that you might see. And if you don't have an expert on your team to help you through that, you might need to Google and search, what does this clause mean? Some of it actually points to you need to follow a FAR, for example. And so be really mindful of what are in all those clauses in your notice of award. The accounting requirements or the reporting requirements are, you do need a standard accounting system similar to GAAP, but you have to take it a step further, and your accounting needs to be able to provide reporting on costs by project. You need to be able to report if your cost is direct to a project versus not direct to a project. So that's your indirects. You have to furnish that you have policies and procedures. Usually you have to have timesheets. So in the next section, I'm going to go deeper into management of SBIR grants, but I just wanted to mention that there are additional reporting requirements when you have an SBIR. And then the focus again is you're more focused on detailed tracking of costs and proper allocation to your grant activities. So is this cost for your project or non-project? Is it allowable or unallowable? And so you'll notice it's different than GAP, which is, did I record this in the right month? Or how much do I record? So this is more measurement and timing, and this is more where do I record this? Which project do I record this to? And can I charge it to my grant or not? And then DoD, in my view, has the most rigorous compliance. There are cost accounting standards that are added usually on top of the FAR. And these are really focused on allocation of costs and your approach to allocating costs to different types of your indirect costs. So it really now dives deeper into, you have your direct project costs, but then you also might have non-project costs, and those might be split into overhead, fringe. So you're going to start hearing new terms here if you have a DoD contract. And so the purpose is really to make sure that when you're doing accounting for DoD contracts, you follow your contract clauses. So it's again about compliance, and similar to an SBI notice of award, you have an award from DoD and they have really specific contract clauses that you have to follow. And then the reporting requirements are also pretty similar to SBIRs, but they do take it a step further in that you have to sometimes do incurred cost submissions, and you sometimes have to negotiate your rates with the government. There's a lot of SBIRs where you can say this is the rate that our company has. An example I'll go over later again, but is NIH. I see a lot of you could go up to 40% on your indirect rate. And with DoD, you have to prove, you have to show them, here's my math, here's all the costs, here are my rates, and it gets more complicated. I just want everyone as founders of your company to know that as you move into different types of funding, you have different reporting requirements. And then the focus is detailed cost accounting and being able to support your costs. One thing also is you'll notice with SBIRs, they may be a little lax when you're in your phase one because of your reporting and the support, because you're probably not going to get audited. And I'll talk about what could trigger an audit versus DoD. There, you have to be on alert. You have to make sure you're audit ready all the time, because they can send an audit agency out at any time to audit you. And you have to make sure you have receipts for everything, even for your meals. And if you don't have a receipt, they can define a cost and say, well, you can't charge this to the contract. And if you did, you owe the money back to the government. So it does get more strenuous when you go through a DoD contract, because you have to keep a copy of all your receipts. All right, so I thought that'd be helpful to go through all the differences. Go ahead.
Mylene, do you want to touch a little bit how DoD kind of goes beyond just defense agencies, how it really is more the standard as opposed to just relating to, in other words, it goes in, if you have a Department of Energy, how it applies to that, for example.
Oh, yes. So the federal contracts, they do go beyond DoD. So I have DoD here, but federal contracts can apply to Department of Energy, as James mentioned. It could go to BARDA. There could be other federal agencies that have very similar requirements. And the reason why all these other agencies have similar standards as DoD is there is an audit agency that is operated by the DoD called the DCAA, the Defense Compliance Audit Agency. And so that DOE, Department of Energy, doesn't have to go and get their own audit agency. They rely on DoD's audit agency. And because of that, DOE and other agencies, they will rely on DoD's really stringent requirements to operate their contracts. And similar to VA would operate under DoD as well. And so I mentioned that because although you may be a life sciences company and you're thinking, well, I wouldn't do business with the DoD, you might. We have different life science clients who do have DoD contracts, and it's a really great way to get non-dilutive funding for research. And there's also CEPI and some other federal grants that are pretty large grants that can help your company along. It's just a matter of finding if there is a good fit with the government where they might be interested in your technology.
Yeah, put another way is the DoD has the deepest pockets in the world, and the contracts, and grants we see coming out of there are often, at a much bigger scale. And so it's an area we're focusing on is how to find, kind of crossover approaches where, life science companies can receive DoD funding, because you think of DoD, that includes, for example, the VA. And they have different needs, and different military groups have different elements that life science companies may be able to get funding for, and it's also non-dilutive, so that can be really helpful. So
You're right. So I don't have a Q&A here just yet, but I will after I go through SBIR grant accounting and management. We wanted to dive deeper into SBIRs because at this stage, we see most companies looking for maybe their first phase 1, or maybe their second, or maybe they're going into a phase 2. And so we wanted to dive into this area because we get a lot of questions when it comes to how do I manage this, or what are things to expect? So most SBIR grants, they have similar requirements regardless of their awarding agency. And so I've seen SBIRs again from different agencies, NIH, NSF, DoD, even NASA, Air Force, that all the agencies seem to have some sort of SBIR at different levels. But things that you should be prepared for if this is your first SBIR. When you get into this pre-award phase, they call it your just-in-time, and there are actually really specific questionnaires they send you asking you about your accounting system. And so most founders I have worked with where it's maybe their first SBIR, they're good up until this point, and they get their first questions about the accounting system. And then there's some panic of, oh, I don't know what to do with this. So here are some things to be aware of and things that they ask you for. So questions I usually see from the agencies are, does your company have an adequate accounting system to accumulate costs by project? Does your company have policies and procedures to properly manage your accounting? Does your company have timesheets and a policy to manage timekeeping? Does your policy have a procurement policy? So these are things that many early stage companies aren't thinking about yet because they're really thinking about the technology and the R&D, and then they get hit with all these questions, and then there's a panic because they're thinking, well, how deep do I have to get into this policy? What are they looking for, et cetera. And so when it gets to a phase 1, I'm going to go to the next slide here. You kind of have to think about the phase. So you don't want to have to dive in deep and do a full-blown setup of policies and procedures and accounting. So really think of it as the phase of SBIR that you're receiving. Phase 1s, they're typically smaller awards of about 250,000. Sometimes they're higher depending on the agency that you're working with. But think basic accounting system. So if you have QuickBooks Online, you usually can suffice. If you're using Excel for your accounting, you probably want to at least upgrade to QuickBooks Online because It's possible to do your accounting in Excel, but I wouldn't recommend it because as you get transactions flowing through credit cards, bank accounts, different things, it's gonna get really complicated to try to track all your costs in Excel and make sure you're keeping up with everything. It's really manual. And QuickBooks Online at least is a good system where you can start to keep your costs really nicely organized. And so the focus is really having a good system to allocate your costs to, so that when you're drawing or you're getting reimbursement on your costs, you can say, here are my costs that I had that I charged direct to the project. And then you might have to bring some of this into Excel to calculate. And then here are my indirect costs that I want reimbursement for. And then later, you may have to furnish what you didn't charge to the grant. So that would be your unallowables. And so again, when you have your phase 1 grant, think about a basic accounting system, and your goals are, when you have costs coming in, you want to be able to define if that cost is charged to your grant or not. And then if it's a grant, a cost for your grant, you want to be able to have a receipt for that so that you can get reimbursement or show support for how you charged it. And then in a lot of these grants, I'll go into a cost proposal section later on how you build out your cost proposal. But a lot of these grants have rates where you can actually get reimbursed for your non-project costs. And these are usually called your G&A, your general and administrative costs. And so let's say you have an accounting fee that you have to pay for each month, you can actually get reimbursed for a portion of that cost that you're paying. You can't get fully reimbursed, but you can say, my indirect rate is 40%. So for every dollar I spent on my direct project, I get 40 cents paid back because I had this other operating cost that I had to pay for. Okay, so that's the basics of a phase 1. Then when we're still talking accounting system. So when you get into phase 2, this is where you are going to want to make sure you have a more sophisticated system. And the reason is you might be subject to an audit. And so I have a slide later where I have outlined what triggers that. But in case you do get triggered for an audit, you want to make sure that your system is really clear on how you're allocating all your costs to project costs versus non-project costs. And sometimes you have to go through even a pre-award survey. And if your SBIR is with a DoD agency, you might actually have to demonstrate to the agency how your accounting system works. And it's, with NIH and NSF, it's more of a check the box and let us know how you do this. And maybe you might have to send some support. So we've even had to send a chart of accounts to show that here is how they set up their reporting. And it really proves that your setup is showing direct costs, indirect costs. But with DoD grants, SBIRs, sometimes the DCAA gets involved and they set up an appointment with you so that you can hop on Teams usually, and you share your screen, open your accounting system, and they have a series of questions to test you and ask you, show me how your system does this. And you have to actually walk them through it to prove that your system can do it. So these are things to be mindful. And again, it just depends on what phase of SBIR you have. So usually phase 1, again, it's more about at least having a simple system. And then phase 2, depending on which agency, you want to make sure your system can actually do all of these things that you say it can do. All right, so those are accounting systems. Now I'm going to get into timesheets here. So let's see here. Okay. Timesheets are required for all SBIRs and STTRs. You need to make sure that your company is tracking time. And some questions I commonly get are, do I need to just track time on the projects? And so the answer is, you need to track time for everything. And what that means is, if let's say you work 40 hours in a week, you need to show on your timesheet that every hour of that 40 hours is accounted for. And so I have here a sample timesheet from the NIH. This is on their website. You can look for NIH timesheet, and they have this as a downloadable PDF. And oh, and another question I get is, does my timesheet have to be very complex? Does it have to be a software? And so the answer to that is it doesn't have to be a software, but it has to follow it has to check the boxes on certain things. And so it can be Excel, or it can be a PDF like this, but certain things that you need to show are it needs to track changes and approvals. So if you're doing a paper timesheet or an Excel timesheet, you have to have somewhere where you're showing that somebody physically signed it. So if it's Excel, you might have to print it out and have someone physically sign it and have that on hand. And so that's why a lot of companies like using electronic timesheets, because with electronic timesheets, you can do a digital signature, and the government accepts digital signatures as long as there is a timestamp and a date and things like that. Or if there's changes to the timesheet for an electronic timesheet, it'll track the changes of who made a change and the date and time the change was made. And so similar to if you were doing electronic, but you're in paper, you would want to make sure that your paper timesheet is tracking changes. But in this timesheet, you can see this, theirs is a little confusing, but the 1st through the 15th is up at the top and the 16th to end of month is at the bottom. So depending on if this was a semi-monthly or monthly timesheet, you could put here, I'm using the 1st through the 15th and just put, that's the period. But the employee, let's say they're tracking 40 hours a week, the total here has to add up to 40 down here. So let's say they did 30 hours on project time. So they would need to list out every project they worked on, or maybe you only have one project, that's easy. One project and they worked so many hours each day, total to 30. And then maybe the other 10 hours for the week was vacation, and they took 10 hours of vacation and they put that here. And so the answer is you need to track all your hours, not just the hours on the project. The other reason that you have to track all your hours is you have to make sure that you're tracking your direct versus your indirect labor. And your indirect labor feeds into your indirect rates. And so that's also why it's important. On the slide, I also have some other tips to, again, make sure that your timesheets are approved and signed. And they should be approved and signed based off at least by your pay periods. So if your pay periods are weekly, you need to make sure you have signature on those weekly. If your timesheets or your pay periods are semi-monthly, you should have timesheets semi-monthly. All right, I'm going to move along to the next sections pretty quickly here, and then we'll jump into a Q&A. All right, so some quick things on grant draws. Your company may incur some pre-award expenses. And so most awards, they do allow that you can get reimbursed for expenses up to 90 days ahead of your award. Not all agencies do this. It's common for the NIH and NSF to include this as possibilities. I always tell our clients to check with their grant manager just to confirm that this is part of their SBIR. Draws are typically reimbursed. So that means that you have to incur the cost and then ask for reimbursement. But the agencies know that if it's, for example, your first phase 1, you may need to advance the money first and then disperse funds to your vendors. So they do allow that. Just remember, if you do an advance draw, you should disperse it to the vendor within 72 hours after you have drawn that grant. And then the indirect rate and the fee that you get to include in your draws, they should be drawn proportionately to your direct costs. And so that means that if for every dollar you spend directly on your grant, if you have a 40% indirect rate and a 7% fee, you should draw your indirect rate of 40% and your 7% fee proportionately to every dollar you spend. Now, I've seen some draws that don't follow this perfectly, and usually it's just a matter of getting permission or getting the okay from your grant manager. I have seen a company where they needed their fee up front because they had a big cost that they were paying for, and their grant manager okayed them drawing down their fee so that they could cover this other cost that would be normally unallowable. And this fee it's technically profit. So what you risk is if you draw down this fee but you don't fully expend your direct costs, you may have to pay the money back. And so as long as you can prove that you are going to spend your direct costs, your grant manager most likely will okay you drawing down your fee if you can show them and furnish proof that yes, I'm going to be spending fully all of my grant budget. All right, so this is the last slide before Q&A, and then we'll pause for Q&A. So I put some compliance requirements here, things to be aware of. Federal financial reports used to be required quarterly for NIH. They no longer require this, which is nice. Their system that tracks the draws, I think, does a really great job. So they're not asking you to report quarterly. But what it used to be is you'd have to every quarter let the government know this is how much I drew from the system, and this is how much I spent out. So their goal is making sure that you didn't draw funds and you're holding on to it, and that you're following the rules and that you're dispersing the funds. But they do want to check this still annually and when you close out the final period. Now, audits. This is an important area. So if your company has expenditures of more than 750,000, it will trigger an audit for any awards awarded up to October 1st, 2024. If you have an award that gets awarded after October 1st, 2024, the new threshold is $1 million. And so it's important to keep this in mind because if you trigger an audit, these audits are pretty pricey. They can run 20, 30,000. And if you didn't go into your grant budgeting to pay 20 or 30,000 or maybe more to address an audit like this, that's a big chunk of money gone to pay for this audit. So if you're able to manage this correctly, you could maybe defer some of the work you're doing so that you stay under the threshold for the year. Or maybe if your award is high enough, maybe you could avoid audit for 1 year and then defer it to the next year. And so when we work with companies, we keep this in mind because it's 20, 30,000 each time. And so in a year, you can try to stay below the audit period, and it's in line with your R&D objectives. It's important to try to do this. And these audits are primarily for the non-DoD types of agencies. So NIH, NSF, if you fall under this category, this is what would trigger the audit for those types of awards. And you usually have to find an independent agency audit firm to do these audits. And so that's who you're paying. You're going to look for a firm that does these. They're more compliance audits. So they're different than a annual financial statement audit in that they're checking your compliance. They want to read your policies on how you manage your grant. They want to check how did you approve costs for your grant. So it's really compliance focused. If you have a SBIR that's managed by DCAA, there is no additional cost for these, but the DoD, I would say, is more stringent, and they're going to sometimes even randomly let you know they're going to do an audit. And then there may be audits on your incurred costs as well. So maybe they're not auditing your systems, but they want to see how you calculated things. Okay, so I know that was a lot on SBIR grant management, so we can pause here for a Q&A.
I have a question regarding the last slide. So in terms of revenue, so the company receives a small business grant, let's say from the NIH, and they're spending down on that grant, right? But that's not considered revenue, or is that revenue?
It is, yes. So the grant is considered revenue. And the reason why the IRS views it as taxable income is because if you receive this money from the government and you don't spend it all down, you can have taxable income. And so a lot of SBIRs, they have that fee component built into it, which is technically your profit. And it's up to the business to decide what they want to use that fee for, because there's no support that needs to be furnished to the government on what you're using it for. So you could technically draw your fee and hold on to it, and now you have taxable income potentially if you don't have other costs that you used it for. So they do consider it revenue.
I see. So if you're not using the funds as you proposed, and you're not
Mhm.
spending down on the services that you need to accomplish the aims and the milestones of the grant, that's when you get flagged for audit. Is that right?
Maybe. So it depends. So if for audit purposes, if you have an SBIR with NIH or NSF or a non-DoD agency, you get flagged for audit if you expend more than 750 if your award is before 10-1, and more than $1 million if your award's after 10-1. So they're really focused on spending. And the way this audit is triggered is it's self-triggered. You have to be, it's in your notice of award, and it specifically says in there, if you expend more than this amount, you must do this audit. And the agency will not let you know that you need to do this. But usually what happens is if you haven't been doing these audits and nobody has asked you about it, when it comes up is usually if you get further along into the award process, they may check their systems and say, hey, we see that you have been awarded this much in grants so far, and you've never submitted an audit. And we're looking at your submissions, and it looks like you've spent more than this amount per your reporting, but you've never submitted an audit. And so what can happen is if you're maybe waiting for an award for your next phase 2, they may put a pause on that until you get the audit done.
I
And
see.
so they will not tell you that the audit is due September 30th, but it is in your notice of award. If you read through it, it will let you know in there if you could be required to do an audit, and it's not somebody reaching out to let you know.
But what if your notice of award says you can spend $1 million? It's part of your budget.
Mhm. You can spend it. It's just up to you if you do or not. So if you don't spend the $1 million in the year, then you're not triggering an audit. If it's after 10-1. And so if let's say you have $1 million in your budget and you have a 12-month period that goes between maybe it's July 1st through June of the next year, you could do 500,000 in year 1 and 500 in year 2 and be under the audit threshold.
I see. Thank you.
Mhm.
Yeah,
And it's a
timing's key. Oh, go ahead, Mylene.
Yeah, no, I was gonna say it's a really good strategy to avoid triggering an audit.
Yeah, timing is key in terms of when you're drawing funds and when you're incurring expenses, so you don't, end up with income, or taxes when you really don't want to have them. As well as kind of not triggering audits you don't need to.
Mhm.
And Lisa had a question that's somewhat related. She says, is it good practice to include a line item for audits in the grant?
Good question. So it's something that you can't put in as a direct cost. They won't allow you to charge it direct to your grant, but you can make sure that you have enough indirect rate to cover a portion of the audit. Or you could plan to use a portion of your fee to do that. But when you are doing your cost proposal, it is a line item that you should consider as part of your indirect costs to make sure that it's something that you're covering. And so I'll go into that when we talk about your cost proposal in the next section.
And then she asked, how does the PI prove his or her own timesheet, since they will most likely be the supervisor for everyone. I think they're implying it's kind of like a CEO level, so, yep.
Yes, sometimes that's tricky if there's a very limited team. You know, a lot of companies I work with, I end up approving timesheets for the CEO because there still needs to be that internal controls. And so if you do not want to be the one approving your own timesheet, so you do have to sort out who else on the team can do that, but there needs to be checks and balances. So as long as it's not yourself and it's consistent and there's a role for somebody to do that, you need to consider who the best person would be to do that.
Good nuanced question. And then Joanna asked, can companies bring their accounting firm on to manage that review with the agency? You know, the
Yeah, and
audit.
the review I meant was when you were talking about the before the grant starts, they'll come on and for the STTR and have you actually go through to make sure that you've got your policies and procedures in place.
Oh, yes, definitely. Our firm, we help with that quite a lot. When companies especially have their first award, we've helped companies put together policies and procedures. We'll help them answer the questionnaire. We'll pull together everything that the agency is looking for, and we'll even be the ones to serve as the demonstrator. So I've logged into Teams meetings with the DoD and DCAA, and I've been the one to do a walkthrough of an accounting system. And then we have the CEO join, and they're more there to observe and just show that the company has executive presence, but they don't even need to say anything. We do the full walkthrough.
Yeah, I mean, there's just a couple of weeks ago, there was a DoD audit, and they scheduled 2 days for the whole audit. And I think you were the lead on that one, Mylene. It was literally just a morning we got through everything.
Yes.
So gave everyone else a day and a half because we were able to just, basically cut through it really quickly and just answer all their questions, and everyone was able to move on by lunchtime.
Mm-hmm.
Let's see, Chi had one more question. Is indirect cost adjustable proportional to the direct and when budgeting, or is it fixed per the funding agency?
Oh, yeah, good question. So it is adjustable. And the reason is, as you're proposing on different grants, your company may change because you might assume that if you get a new grant, you may have new costs. And so then you'll need to recalculate what your costs and your indirect rate might be with this new grant. And so the important thing is to be able to justify the rate that you're proposing and why your rate is now different and why it might be higher. And it's usually because if you have a new grant, you're going to have higher costs.
All right. So yeah, we're running a little behind, but we are scheduling a break here. We tried to move fast, but so any final quick questions before we take a break? How should we take like a 10-minute 10 minutes enough for everyone?
Yeah, let's go for a 10-minute break.
Okay. All right. So
Sounds
we'll plan to meet back here at 10:24 Mountain Time, if that works with everyone. I see another question. We'll pick that up right when we come back from break. But let's everyone can get refilling the coffee, what have you, and we'll see you back in a few minutes.
All right.
All right.
Excellent. Thank you.
Yep.
That came in right before we went on break, and I can take some time to answer this. So the question is, I think academic institutions can negotiate their IDC rates used in grants with government agencies, e.g. NIH. Can small companies do the same? So yes, companies can negotiate rates with the government. Now, do I recommend it? No. So it depends. So with NIH, I mentioned that the rate that you typically can go up to is 40%. And usually they don't question if you're able to support these costs up to that 40%. Usually, if you have like your phase 1, if you're in phase 2, it's a good idea to try to show that you can support at least that 40%. And so I wouldn't go through the trouble of negotiating your rates if your actual calculated rates are at or below 40%. If your rates, if you calculate them out, if they actually are higher than 40%, that's when you might want to go through the trouble of negotiating rates with the government. And it's not easy to keep up with the compliance once you have negotiated rates. And you can't go back and say, I don't want negotiated rates. Once you negotiate your rates, you are now locked in to prove your rates twice a year. You have to request your rate at the beginning, at the start of each year. So you have to tell the government, I calculated my forecasted rates, and this is what I think they'll be. So this is what I'm going to use to bill you. Then after the end of the year, you have to go back and recalculate it and see, did I actually have those rates and did I charge the government the correct amounts? And if you charge the government perfectly, then you're good to go. If you overcharge them, you have to credit them back or refund back anything you overcharged. And if you undercharged, then you might have just lost some money there. So it's important to understand if it makes sense to negotiate the rate. So are you at or below 40% already? I wouldn't bother. If it's higher than 40%, is it worth the compliance to track all your rates and calculate them twice a year and prove them out and submit your rates to the government each year? And the process to submit your rates and a cost proposal submission isn't just a simple, here are my rates. You have to actually provide quite a lot of support with to NIH, for example, of here's my team, here is all my policies, here's how my labor is just distributed through all the different types of costs. It's pretty tedious and it takes several hours just to manage a cost submission. So you really want to be careful if you are considering actually negotiating rates with the government. All right, does that answer the question, or is there any follow-up to that? Does that help? All right, and I don't, okay, perfect. Okay, so we'll move on to the next section, SBIR grant cost proposal basics. So now that we've covered the expectations for how grants need to be managed and how they're operationally set up, I thought it'd be helpful to actually go through what a cost proposal looks, or the components of it. This is where I see many founders have challenges with their proposals because you need to really think through all the costs that the company can incur. And you also want to make sure you're leveraging your SBIR funds adequately so you're not leaving any money on the table. And once you have that proposal out, it's a little difficult to go back and say, hey, I want to change my proposal after it's awarded. So at the beginning, it's important to spend time making sure that your cost proposal is considering all of the costs that your company may have. So there is typically 4 components in a cost proposal. You have your direct costs, you have your indirect costs, you have your indirect rate, and then there's a fee. And again, the fee is similar to the profit or your residual funds that you have on your grant. I'll first dive in a bit more into what the direct costs are. And so the direct costs, let me just bring these all up here. These are your costs that are incurred specific to the project. And so when I work with founders, this is usually the easy part. You have usually it's a lot of employee labor. You have your contractors or consultants, and then you have your supplies and equipment. And you generally know these are the aims or the targets that I have in my grant. And so I know these are the costs that I'm going to incur that I can directly charge to the grant. And so this is usually a piece of cake. We get through this and there's no problem. The challenging part is when you get to the indirect costs. So indirect costs, these are costs that you don't attribute direct to your grant. So these are a lot of those supporting costs for your business. And I'll click through to bring these all open. So you have your general costs of running your business, administrative costs, rent, utilities like telephone and internet, accounting is a big part, your audit. When you talked about the audit, you can consider this an indirect cost. And just really thinking through what all those costs might be is really important, because a lot of times when companies are doing their budget justification, the first focus is on the direct costs, and then there is a little bit of an afterthought on what are all those other costs my business might incur. And so if you do a good job in making sure you cover all your costs here, that will help you really build up a nice indirect rate. So the indirect rate, it's unique to each company. Not every company is going to have that same indirect rate. The formula to calculate your indirect rate is you take all your indirect costs divided by your direct costs. I have really oversimplified this, but that's generally the formula. So if you take all your costs that you estimated to support the business and you divide that by your total direct costs, then you have a rate. And when I say total direct costs, I'm referring to all the projects in your company. So if you have one grant, then it's all the costs that are under that one grant would be your denominator, your direct costs here. But if you have 2 grants, you would total up those 2 grant direct costs, and that would be your denominator. And then your indirect costs are all the costs of your business to get your rate. And so the typical rate I see the NIH will go up to without justification is usually 40%. And so I tell companies, if you are building out your rates, what happened there? I'm having a issue with my slides here. Let me bring these all back up. Okay, if you are calculating out all your rates, you want to make sure you try to fill in as much as you can for this 40% if there's enough budget. You also have to keep in mind the ceiling of the award itself. A phase 1, if you can only go up to 250,000, it is important to kind of strategize on how to build in enough cost to cover your directs, indirects, and fee. And so when we get to the fee, I'll talk about a strategy that you could use there. And then sometimes with indirect rates, there's a ceiling on the rate itself. Some agencies say, if this is your first award and you have no support to justify a higher rate, where you can go with their ceiling of 20%. Sometimes it's 10%. So hopefully there's no ceiling, but sometimes there is. And so these are things that you have to consider when you're reading through the application and what the agency will allow. But the important thing is don't leave any costs on the table. Okay, sorry, I'm having some issues here with my slides. Okay, I'm gonna skip forward here. Okay, here we go. Okay, so the last component is the fee. So most agencies are required by law to allow a reasonable profit or fee. And typically it's in a range that I see of 7 to 11%, but most commonly I see 7%. There are certain agencies who do not have to do a fee depending on the grant. So if it's an STTR, usually there's no fee that's included there. But one common mistake I see with the fee is it's an afterthought, and it's something that's thrown in as well, this is how much budget I have left because my ceiling is 250,000 and I'm using most of that for my direct costs. So I don't have room for indirect or fee. But if you flip it upside down, it's really a helpful strategy. If you start with your fee and you know that the agency allows up to 7%, you'll want to first say, here is what I'm setting aside for my 7% fee. And then you can take the remainder to then budget out your directs and your indirects. And the reason why it's a good strategy to do that is your fee doesn't require any justification. You don't have to prove what you're going to use it for. And as I mentioned earlier, you could even hold on to the fee and have a profit if you wanted to. And so it's nice to first plan for the fee, because you can really use that for many different things that come up that might be considered unallowable. And a big one I see that fee is used for is IP costs. IP is generally a type of cost that is not, you can't charge it as an indirect or a direct, but you can charge it to your fee. In addition, there are other types of grant add-ons, I'll call them, like the TABA funding, where this is for the advancement of your business technology, and you can use TABA funds to pay for certain costs like IP, accounting. There's a different costs that might typically be unallowable that you can use for TABA as well. All right, so I went through that pretty quickly because we also want to try to catch up on some time here. So I'll pause there for another Q&A. And then after this Q&A, we're going to go into investor ready pro formas. All right. So I see a question in the chat. What is TABA? So TABA is a special add-on to a grant. So when you're applying for a grant, you can actually add this add-on. So for if you have a phase one, you could add on maybe a request for an additional 5,000. And as I mentioned, the TABA funds really are focused on advancing the commercialization aspect of your R&D. These government agencies, they're funding your project, your R&D project, because their hope is that you're going to commercialize your technology. And so that's their interest in helping fund your innovation. And when you get to higher levels of phase two, sometimes the TABA can be 25,000 or 50,000. And so it's different for different agencies. Some agencies require you to specify which vendor you're going to use, what types of costs you're going to use. NIH sometimes is a little more laxed on what you're going to use it for. They just have some general guidelines on these are what you can use your TABA funds for. But you can add it to your grant when you're initially applying, or if you didn't know you could have TABA funds, you could reach out to the agency you're working with, and you can try to put a request in there after the fact as well. Any other questions?
All right. Well, we should probably keep rolling. We're got a bit of ground to catch up with here. So we will stop. We'll stop for a bunch of other times on the journey here.
All right. So we're heading into investor ready pro formas. It's one of my favorite areas as a CFO, but I'm going to turn it over to James to get us started on this part of the program.
All right. So we, it was great. Earlier, we got another one of those questions that kind of led us into this a little bit ahead, but essentially, investor pro formas are one of those really key areas that make a huge difference in terms of how companies are able to look forward. In a vehicle, you have a windshield and a rear view mirror. And there's a reason the windshield's bigger than the rear view mirror. The windshield is looking down the road. And so you can kind of think of that as the way you want to think about, investor ready pro formas. And it seems like one of the big differentiators of companies that move forward is those that are planning and looking ahead towards the next step. And so see here, let me find my right starting point. So with pro formas, pro formas are used for a bunch of different purposes. And I think Joey asked earlier, what's a pro forma? It's simply, it's a way that your company forecasts out its future performance. Typically, it's done in the form of kind of financial statements as if they were in the future. So some different purposes of these. One is, even if you're not going for funding, using a forecast for operations is really key. So we're often we have different types of forecasts. One of them is an operational. Typically, we're 1 year and plus out on the forecast, and we're really trying to dial in on what are the plans for the coming year. And then quite often we're reforecasting on a quarterly or sometimes on a monthly basis to, to factor in actual results and changes and so forth. Essentially, it allows you to plan, plan for opportunities and challenges, and also, kind of control how you're doing, because you're often looking at budget versus actual as you're moving along. Another key purpose of pro formas is for planning. You're looking at different planning scenarios. For example, what if we received, 10 million of funding versus 20 million? What if we change the price of our, if you're commercialized, what if we change the price of our product by a little bit? What if we, we may have what if scenarios of, best case, worst case, base case, and so forth. So a lot of, scenario planning could be another approach. And yet another one, and the one we're going to talk about most here is investor-ready performance. In other words, we're looking to prepare for fundraising. And what we're doing when we prepare investor readies is it's typically a much longer time horizon. We're typically making these at least 3 years, sometimes 5 or 6 years, but typically, the way to think of it is you're trying to demonstrate, looking forward, how you're going to reach that value inflection point and how you're going to get beyond that, into at least to the next phase, sometimes even beyond. And you're basically using this to demonstrate how you're going to use funds. You're going to, what is the amount you're going to, raise, how are you going to spend it? And then quite specifically, how are you going to spend it in a lot of different ways? I talked about it earlier when we were starting, which people are we going to hire? What order are we going to hire them in? How are we going to, how much are we going to spend through? How quickly? What is our burn going to be? How long is it going to last? Essentially it's all your plans in detail. But it also, a good pro forma will have assumptions with it. So you're you're able to explain the why of how you're spending things. It's not just putting, kind of guesstimate amounts in and just saying, hey, payroll $100,000 and, well, maybe it will increase 10%. You're kind of putting in the specifics and being ready for fundraising. So the other thing it does, it's showing that if you're requesting funds, if I'm requesting, 5 million, for example, that seems like the amount I need based upon the reality of my plan forward. And it's also going to get me to the value inflection point that I'm aiming towards. And so very typically, there's a, 2 years, sometimes 18 months is looked at as, the spend period. In the moment, funding has just been a lot slower and harder to come by because the capital markets have clogged up a little bit more. And so, a bit, ideally, you have a bit of runway. You don't want to just get to your value inflection point and then be out of cash and out of gas, so to speak. You want to be able to have, life happens, and you want to be able to plan for some margins for unforeseen things that happen. And so, very typically investors are going to, allow for example, 6 months, possibly 12 months, beyond, recognizing that, there is some uncertainty and that you do need a little bit of runway beyond, wherever that value inflection point is. But essentially, you're demonstrating that the science and everything is going to come together during a period of time. And so moving to the next one, actually I jumped into a completely wrong slide here. Let me look at what you're on here. Okay, I am on that one. So let's see. So I'm going to skip this slide because I covered this earlier. We were working on this morning. So we already went over this slide. And I think our deck's messed up a little bit here. So we already went over this, didn't we, Mylene?
I think it was here again. So I don't know if you want to just skip to the next section then.
Yeah, I think I kind of get lost up because I'm not seeing that in that in the deck I'm looking at. So we have different decks here.
Okay.
So anyway, so in a nutshell, that relates to the planning. And why don't we just jump right into, we had a Q&A in there, but why don't we just jump into the next step, Mylene, that you're going to cover in terms of gathering the data for the proformas.
Okay, that sounds good. And I think that'll help with time, so we'll keep things
Yeah.
moving along. So James just went through, why you should forecast and different uses, and I'm going to go through the actual process. And so let me bring us to the next slide here. So in this section of our program, we're looking at the process of how you build out a pro forma, but we're not expecting that you're going to actually build out a pro forma after you take this class. So, but what this will help you do is understand the process and how you might better prepare and approach building this out. And this is something that's very much a team effort. And so it's ideally that you'd have some input from others and some help as you go through how to actually build out the pro forma. But overall, the goal when you're building out a pro forma is you want to keep in mind, what are you doing this for? And so I have some tips here on keeping the end in mind of why you might be also building this pro forma. So when you're fundraising, the goal of your pro forma is to do that homework so you can create a pitch deck slide at the end. So later in the workshop, I have some tidbits to share about what you could do to present a pitch deck slide. Your pro forma is going to help you summarize what your investment is. It'll help you do the homework to figure out how much runway you're aiming for, or if you have a certain fundraise amount in mind, you'll be able to see, does that fit the runway that you're saying you're going to have? And then your pro forma is going to help you better understand where you're using your funding. But again, this portion is really so we can go through the process and understand how to approach it. So when you're building the pro forma and you're fundraising and you're thinking more investor ready pro forma, another thing to keep in mind is you're trying to illustrate a story for your investors. And when you're pitching, there's a story of your technology and your company, but it's coupling that with the numbers and how that timeline works out, how much you're going to spend in that timeline. This all needs to come together, and there's a lot of different metrics you can pull together. All right, so with that said, we'll talk about the process. So, there's a lot of different ways you can approach building out a pro forma. And I found breaking it into these 3 steps really helps just compartmentalize each of the steps. And it gives you a clear, this is where I can start, this is where I go to next, and then this is what I do with how do I build it. And so we'll look at this first step, planning and strategy. I'm going to skip through the Q&A here to keep up with time. Okay, so planning and strategy. A good place to start is with your development timeline and your milestones. So a lot of founders I work with, when you're working on your different technologies or your R&D projects, you can put together a Gantt chart of how you're going to develop your product or your technology. And you can outline the different steps in your Gantt chart timeline, and you can bring it further by looking at when I'm developing my product, where is there going to be value created in each step of the product and in the development. And you can also put numbers to this. And so I'm going to bring up, I have this actually in an Excel that I'm going to share. So this is an Excel I have here of a simple Gantt chart, and we could share this with anyone attending today. But it really helps you really identify, here is the project I'm working on. Maybe you have a project A and a project B. You can name your project here, and then you can think about what are the milestones that an investor would find valuable, that if I ask for 200,000. I'm going to spend it on this project, and here are the milestones I'm working towards. And then let me see what those costs actually look like. And then you can take it a step further and actually see what the timeline looks like. So oftentimes when I work with companies and they're pitching to investors and they have those follow-up meetings, investors, they in particular say, you know, I know you want to, work on this project, or you're developing XYZ, but what does that look like as far as timeline? And how much are you spending between this and this to get to your milestone 1 versus milestone 2? And so doing it in this Gantt chart format is a really helpful approach, in kind of thinking through how will I start mapping out my costs. You can also, in your pitch deck, take that information and create a milestone map. So this is really simplified. You can hire a designer to make it look a lot nicer, I'm sure, but this is just to give you the idea that you can take that data and now clearly show an investor, I'm raising a 5 million seed, and I'm working on these 2 milestones, and you'll want to specifically name what the milestones are, and this is the cost to it, and this is the time period. Sometimes in these milestones, you may even have additional elements in here that you're even saying from this point to this point is a quarter, and we're going to be spending 500K to get this initially started, and we're going to be hiring full-time employees, and our headcount's going to grow from 5 to 20, and we're going to be spending this on our overhead and G&A, our operational expenses. And so those are some of the things that you can highlight in your milestone map. All right, so in your planning, some other elements to consider other than your milestones are your overall fundraising timeline. And what I mean by that is considering how long it's realistically going to take to actually bring that funding in. Fundraising, it can sometimes take 18 to 24 months in between a fundraise, or it could take 8 to 12 months to raise funds. And you want to make sure that if you have enough cash today for the next 6 months, that you have already been fundraising 12 months ago, and that you're going to be bringing in funds soon. Or if you have funds today that go through the next 18 months, you want to make sure that you're already fundraising, because you want to make sure you close your round and you actually have cash deposited in your bank before you run out of cash. And so in your fundraising timeline, you want to outline not only what your runway is, but when is that money going to be planned to come in. You also want to consider in your planning contingencies. So different things happen in the economy. Last year, there was some bank closures that caused companies to scramble and sort out, where are they going to put their money? Am I going to have access to cash? And it brought up concerns of, where is the safest place to hold our cash, and what happens if I don't have access to my cash? So there was different companies I worked with where we did some contingency planning on where they would hold their cash. And sometimes fundraising takes longer than expected. I've worked with different companies who have planned to bring in funding by the end of the year, and it didn't happen, but they were able to, instead of maybe bringing in a Series A, they were able to bring in a smaller round of safes or convertible notes. And so if you have a shorter amount of funding that came in, you have to then cut some costs or have contingency plans to extend your budget further out with less money. And so in your planning, you have to start thinking about these things before you get into your pen and paper and start writing things down with your pro forma. You want to start really thinking about what are things that might happen. When COVID happened, there were just different supply chain issues, and companies not able to move forward with certain testing because they didn't have access to what they needed. So those are other things to consider as well. And then the final thing in your planning and strategy is thinking about scaling and ensuring that your pro forma, especially if it's for investors, you're showing how you're reinvesting that money into the company to show growth. All right, so I went through quite a lot there in the planning stage, and I'll pause here for a brief Q&A. And then in the next section, we're going to talk about the types of data that you can gather. But I'll pause here briefly if there's any questions at this point.
Yeah, so a question came in on the TABA funding, how you can use it. So you can use it for, IP planning, kind of strategy and protection. You can use it for, kind of assessing your markets, market assessment. You can also use it with getting your, government approved accounting system or set up, and also looking at how you're going to, your commercialization plans, your go-to-market plans, and so forth. So those are some areas that TABA funding can be used.
Perfect. All right, well, I'll keep us moving along and we'll go into the next section. And we'll have another Q&A after this section as well. So I'm going to go into the types of data that you can gather as you're building out your investor ready pro forma. So we'll start with revenues. A lot of companies in life sciences, you have no revenues usually. But if you do have grants or you have any licensing agreements or collaborative research agreements, you may have some revenues. And so it's a good place to start to consider, do you have revenues that would be coming into the company? And if you do have revenues, usually when I'm working with companies in life sciences, these revenues are usually tied to some type of budget of expenses. And so if you have your project budgets, that's a good place to start because now you already have that starting point. So if you have your SBIR cost proposal, for example, that's a nice starting point of, okay, I know already I have these revenues that'll come in and it's based off my cost, and here's the cost that I have planned. So that's always a nice, easy starting point. Then from there, other expenses to look at are personnel, meaning your people, your team, other R&D costs. And when I say R&D, I consider this separate from your R&D that's paid for by a grant or by a collaboration partner. This is internally funded R&D that you're actually going to use your investor funding for. And I like to bucket this differently because when you're fundraising and you're going to use investor money for a specific R&D platform or technology, you want to be clear with the investor that you're using it to advance this specific program in your company, and this is the internally funded R&D that you're using their funding for. And then the other bucket usually is G&A. What costs do you need to support your business in general? So you might have software costs that are for the business, insurance, and things like that. And so I'm gonna pull up some key notes here that are also helpful. When you're planning your costs, I mentioned earlier, plan by projects and milestones. So again, that's where you could take it from your SBIR cost proposal. But a step further is, let's say you don't have a grant and you just have internally funded R&D. It's a good idea to do a Gantt chart for your internally funded R&D and plan out your costs by those projects and milestones. And then you may have other personnel who don't work directly on your projects. Maybe you have you're the CEO. Maybe you're focused specifically on the advancement of the company and not the R&D projects. So you would be more of a general personnel cost, or maybe you have admin support. Those are the other personnel costs that you might consider. So I'm going to bring up.
There's a quick question that's timely. Is does management?
Oh, okay.
Do management expenses go into G&A, like CEO, CFO?
Yes. So one thing that I like to do, and I have an example here, is I like to have a tab in the worksheet for Performas called personnel, and that's everybody on your team. And so let me bring that up here. I have a template. And so you'll see I have here the CEO, and just different roles, that executive type roles. But you'll see in this tab, I have it broken out between their groupings. So you have a G&A grouping, and so your CEO, CFO are in that G&A department. And then for R&D, you might have your CSO or your senior scientists or research associates. So even though I have everyone here in this one worksheet, so I can outline all the roles, I also have them broken into departments. And the reason why I have it broken out into here is so that when I look at my costs between R&D and G&A, I can actually look at the labor side and pull those in here to see what are my full R&D costs with and without labor. And
Yeah,
so,
and
yes, I would put those folks under G&A.
as a rule of thumb, yeah, certainly in a bigger
Mhm.
company. Now, the smaller companies, yeah, it may be a bit of a split. People may have a CEO may be involved in doing the research too. And so there may be direct time so they may be split between G&A and direct.
Yes, good point. Yes, and that's oftentimes the case. And even with your SBIR cost proposal, typically they wouldn't see the CEO as having direct time, but in a smaller company, it's acceptable and justifiable that if you're the PI and the CEO, you may have direct time and you may have G&A time. All right, so I'm going to walk through the different other worksheets that are on here. So on the G&A worksheet here, you'll see that there's a summary section of different types of G&A costs the company might incur. And these are the costs that you want to consider and do some homework to figure out what it might cost to have these things. Business tax licensing, this is a summary here, but down below I actually have detail of what those costs might look like. So you may have a city business license fee, directors and officers insurance, state tax fees, corporate legal, IP, contracts. Sometimes even we break out IP because it's such a significant cost and investors are interested in seeing how much are you spending on IP in particular. So you could even think about, isn't it important to break that cost out of G&A? And so there are different approaches to presentation that you can decide to have here. But the important thing is to consider all costs that you might incur. And so maybe you don't have a D&O insurance policy today, but you start to hire different executives or board members or things like that, and you decide we need to add this insurance in the future. And so I want to make sure I have a quote to see how much that cost might be. And then there's other ideas here of other financial. So if you hire an outsourced accountant or a consultant to do different things, these are different things that you might consider getting quotes for. Another big one is you may have yourself or your team attending different conferences. These could be G&A costs that you want to make sure are covered when you're fundraising, so that you can continue to promote the technology, attend conferences, and things like that. There might be association fees, softwares to think about. So there's quite a bit to dig into here and really understand how you might operate this business and what are some really important things that you want to make sure are funded and that you're including in the budget here. Also, when you're pitching initially, you're not going to get into this level of detail when you're doing your pitch, but you want to have some totals here. And so later when you get into diligence is when you might actually have to open and walk an investor through the detail of what you're considering. So they can see that you actually did your homework and considered all costs that might be possible. And then for R&D, we did the same here. There's this other R&D costs that you might consider and by project, as I mentioned. All right, so I'm gonna head back to the slides and we'll pause here for Q&A if anyone has any questions on different types of costs.
Yeah, one quick add to what Mylene was sharing there is that it's very stage dependent. So she was showing a fair amount of detail. And so, what you're the level and depth of forecast that's expected at, a seed stage is very different from a series A or B stage. So don't get overwhelmed by the depth of that. But a little bit, it can also help you understand the reality of the costs. So it's all relative to stage. And any other questions we can get into? Let's see, second, how important is it to have those cost categories before using QuickBooks Online? The QuickBook, I think you're referring essentially, I mean, generally companies, it helps to have QuickBooks Online fairly soon, but or just an accounting system that's not Excel. But if you're just putting expenses into categories early, Excel can work, but it usually helps to transition to an accounting system, once you actually get some moderate spend going. If you get a phase one, certainly if you have a phase two, SBIR, or if you get some funding, and usually that's built out in the chart of accounts, is where you're building out those categories.
What?
But even in Excel, you're essentially building out categories. So
James and Maylene, I've got a
Oh.
question for you. Oh,
Oh, I think
Go ahead,
someone
Chris.
needs to go on mute.
okay.
Right.
Yeah, so you had talked about kind of these kind of stages of fundraising, and you're kind of always thinking about this next round. But then we talk about, sales, and all of a sudden you should have revenue from a forecast that's coming in to support operations. That's kind of where we're at. We're commercial ready. We've started commercialization, in fact. So, we have a forecast. We just started, so I give it an accuracy of like, low single digits. But how do you think about that? Like, when we present to investors, we don't want to come in too low, like our product is junk and we can't sell anything. We don't want to come in too high, because we want to have this kind of safety net of funding. Like, can you just walk me through kind of the logic, maybe how we should look at it and how investors think about somebody's forecast?
So yeah, I mean, there's a few different ways to think about it. One is, you recognize, everyone knows, the future's uncertain. Everyone recognizes you're just, you're trying to do your best with what you have. And so essentially you use the knowledge that you have, and so, one of the best sources of that can be any contracts you have, any comparables that are out there in the marketplace, as much as possible, trying to look at how you ground your information in, areas that really make sense. Do you have, are there codes out there that you can, reference, and, reimbursement codes? So much depends on your specifics, but you're looking to ground, what you have in something that, isn't just like, I just made it up. And so that's so dependent upon the specifics. And then, the other thing we're sometimes doing with revenue is layering in what are known contracts and then what is like future revenue. And so if we have a baseline, we're kind of sometimes creating layers of certainty there. We have, or maybe multiple layers. We have this hard, solid contract with a government contract. We got this commercial contract, but there's some uncertain clauses, then where there's totally new business. And so there's a lot of ways to do forecasting, and revenue is often the hardest part of that, that takes, that has the most art to it.
Yeah, and I would add, when you're building out the revenue side, you should consider, does it make sense? If you're entering into an existing market and you can identify what that total market size is, how much percentage of that market are you looking to take on, and what's the plan to make that actionable? And would an investor buy into that? Are you able to show that this is something you guys can actually execute on? And then if it's a brand new market, it's a little trickier, because now you have a whole new entire market that you're trying to break into. But I think it's more about does it look realistic? And do you have a plan to actually execute those revenues?
And yeah, one more thought about new markets is people often underestimate new markets, you often have to educate the buyer, because they don't really get it offhand, and it slows down the sales cycle. So that's a consideration of, the new markets. And one other thought is, trying to run it by people that are, there's people that are good at commercialization, that are, do it, they've done a bunch of it. And so get feedback, because often people come to us with these pro formas and we're like, okay, do we divide this by 3 or 4? It's kind of wildly optimistic, and you want to, getting feedback from, other parties. You can kind of think of creating pro formas as a team sport, because rarely is one person going to have all the answers. And so you're looking to, get input and, from people that, have a better sense of it. Other questions out there? All
Right.
right.
I think we can
Keep
move
rolling?
it along
All
to the
right.
next section.
Excellent.
All right.
Okay.
So I'm going to transition it over to you, James, to talk
All
about
right.
how to build it.
Okay. All right. So it's time to get your Bob the Builder hat on here. And so in terms of how you build it, this is one more of those early questions of how you move forward. Excel obviously is can be an approach that you use. It's it has its limitations, but it's also very available, so it can have a real plus certainly in getting started, or even if you're going to put a lot of information in, it can be a great starting point if you're going to turn it over to someone else. We're often asking our clients, what do you have as a starting point? And it's super, super helpful at kind of catalyzing and moving things forward. Generally, it's hard when you're getting really complex. So that's why there's a comment about, basic cash forecasts can be good, kind of income statement only forecasts are ones that work in some cash flow and income statement. But when you're getting complex, it's hard, Excel is a hard one. There's a lot of different software solutions out there with various levels of sophistication. If you're going to do it yourself, you often have to then learn how to use that software. And then there's also, we talked about cash and accrual before. Then there's the question of, are you creating true accrual-based financials that you're going to want to be sharing with investors, or are you really just creating cash basis financials? And then, more sophisticated, tools will include, kind of, balance sheet, income statement, cash flow. This also might include some dashboarding, reporting packages, and so forth. And there's quite a few different tools out there, depending, with different levels of sophistication. And let's see here. Yeah, the other thing I'd say is, sometimes it helps, getting help with where you need it here is often really helpful, because it's, like I said, it's quite often building pro formas is a team sport, and it often helps to really focus on the strategy, and less being bogged down. It's really easy to get bogged down in the mechanics if you're trying to build a complex model. Some people can do it, but it's it's good to kind of not try to do too much if you're trying to also run the business at the same time. And then what else can I say on that? Yeah, and I also mentioned there's levels to it. You just want to consider, where you're at in terms of the stage of the business. So in terms of some good moving ahead, kind of some forecasting tips. The other thing, kind of a couple recommendations, definitely use their standard technology, and I think there's, be aware of just kind of introducing kind of like, I don't know, stuff you may have read about on social media and putting these quirky terms in there's a lot of the terms have a lot of meaning in terms of, people won't understand unless you're using kind of standard language in the forecasting. The other thing is make sure that your forecast, I mentioned it before, it should align with your historical data. It should align with your pitch deck. It should align, you have milestones that are going to be in there. And also your story. It's all gonna, come together, because the more you know, all these elements don't come together, it makes it, you know, it's things that are going to make an investor feel uneasy. And, you know, it's ultimately just going to raise questions. And then the other is just making sure, you know, what you're presenting is really clear. You know, don't present a lot more detail than you need to, you know, depending on, you know, there's different contexts, you know, for the forecast, but, you know, make sure your key points are really clear, because it can be easy to get it lost. And so make sure, yeah, your use of funds, your burn, your timing, you know, make it clear in terms of, you know, how those inflection points are happening. And sometimes it also helps to add, you know, some visual to what you're doing with the forecasting, and or to represent the visual in your pitch decks. So going ahead to the next one, you know, we see all sorts of different things coming in. We had, you know, particularly when we have, you know, engineering firms, we see these crazy complex forecasts coming in terms of, sometimes in terms of, you know, one came in, you know, it's actually you know, derived kind of from a client, but there's like 30 different tabs in this, you know, and it took two people driving it to try to explain it to an investor in terms of what was going on. And it, you know, really was hard to understand what was going on. And so anyway, so there's, you know, you want to be able to basically be able to explain it quickly. And to move to the next one, you know, there's a lot of financial models. This is an example of a kind of a grant-based, you know, financial model. So, you know, it's pragmatic and simple. You'll notice, you know, this is kind of a common format that sometimes companies use internally. You know, there's like cash is at the top. There's all the revenue. It's often cash basis. And then you have the ending cash. So it can be helpful, but this, you know, the thing to understand is that this is not a kind of a corporate or a GAAP, you know, based financial statements. It, you know, does show you where your direct costs and, you know, to some extent what your gross profit is, but it, you know, this doesn't include like G&A, you know, breakout, you know, which can be really helpful. It doesn't include the, you know, R&D expenses, you know, how much capital is required, all sorts of elements that you know, that investor is going to be looking for. So in a nutshell, yeah, don't make if you're, you know, this is often forecasts are coming in, you know, during due diligence, but don't make your investor guess in terms of what they're looking for. And so, you know, with the next one, I'm gonna transition to Mylene, but she's gonna talk about, you know, in a sense, how do we approach this? What is the right approach to prepare, you know, proper forecasts that investors are going to be looking for?
Great, thanks, James. So I'm bringing back up that Excel template, and we had looked at earlier these different schedules where you can capture details of costs. So now I'm going to show you how all these costs, these three worksheets, come together into your overall detail here. And so I'm going to actually scan this open. And you'll see the way this is set up is at the top, this helps us keep focus on what are the different milestones, what are the different fundraises that we're planning for in here. And it aligns with now your P&L. And down here, there's a statement of cash flows, and then you have your ending cash. But all of the costs that are in here are actually feeding in from the different worksheets. And so you'll see that we have formulas in here from the personnel worksheet under G&A. We have formulas in here from the G&A worksheet. But this really helps companies now pull the planning they did into the actual forecast. And what you want to do is think about it on a monthly basis. A lot of investors, they want to see, if you do a chart of this, how things are moving along monthly, but you can also break this down further by quarter. So we could easily see this is a quarter here and a quarter here. And you can even get more sophisticated and break it down by a high level annual summary, which is here. So we have everything now broken down annually. and we can see what is it looking like on an annual basis. And so James had mentioned when you're building out your forecast to try to use some standard financial nomenclature. So for the format usually follows an income statement. So you, again, going back to the first section of our talk today, we talked about the structure of an income statement. It starts with your revenues, then it goes to your expenses, and then you have your operating income or loss. And then you might have, you might outline your EBITDA from there. So that's the format, the standard financial nomenclature, and having revenue on top. I've seen different forecasts where I take a first look at it and it goes into expenses first, and then revenues are somewhere down at the bottom, which is now out of order of what you'd normally see in an income statement sequence. Other things that you could consider in your forecast are the cash flowing in and out. So usually in the bottom of the detail, you might have in here information on cash coming in from fundraisers. So you could see how that affects your overall cash flow. One neat thing you could do is you can start with just all your costs and revenue coming in. And what this would do is help you see if I need to have a runway that covers the next 2 years, how much money do I need to bring in to cover that? And you'll see that in January, in 2 years from the beginning of this January, the company would be negative 5 million. So maybe this first fundraise needs to actually be more than 5 million to make it past that point. Or if you want to have 1.5 million by the end of the year and you're going to have a 24-month runway, 5 million is adequate because that gives you this plus maybe another month or so of runway. So it really helps you kind of assess how much money do I need to raise if I know what all my costs are. And so that's a really nice tool that you can use with these forecasts, is answering that question. Am I raising enough money? And sometimes investors ask, why are you raising 5 million? Or why are you raising 1 million? And is it enough? So this will help you answer those clearly on what you're funding. And so having it in this format is helpful. And then I will say, even though we are presenting this in Excel, day to day, we don't actually use Excel, we use software because forecasts we work with are a lot more complex, but I do use Excel quite a lot in building out schedules and Gantt charts. So I could feed it into our software that we use. All right, so I'm going to move us into another Q&A here and see if there are any questions at this point.
Yeah, a couple came in. I'm willing to share the Excel. Sorry, it's actually one of the pieces of IP we have sort of behind. So even we do have a little bit of secret sauce, different templates we use for clients and so forth. But we will be sharing a number of different templates as well as this presentation afterwards in the slides and all. So another question Jake was asking, should the pro forma be modeled as best case scenario, most likely in terms of revenue, market share, and so forth? Eileen, you want to take it?
Yeah, I'll take it. So when you're fundraising, I'd say yes, but make sure it's realistic. And so you have to think about the investor that you're pitching to. It's likely a partner who's representing maybe it's a VC that you're pitching to, and they need to go back to their team and advocate for you. So they need to have certain things answered, and they need to believe that you can actually do these things. So do best case, but a best case that seems realistic, that they would believe that you can actually execute. And of course, have different scenarios in the backs. Behind the scenes for operations, you might have a scenario that's your actual realistic scenario today, so that you know how much runway you have today. But in your scenario for investors, you're going to show what it looks like if you actually had, let's say you're raising 5 million. What does it look like if you actually have the 5 million, and what revenues do you think you can actually achieve if you get this 5 million coming in?
All right. Any Any other questions out there before we jump into the pitch deck elements?
Yeah, so I have a question regarding, so would you tailor a pro forma differently for example, a pharmaceutical startup company that has a drug that has to go through the regulatory process before actually generating any revenue? How would you
Mhm.
develop a pro forma for a company like that?
Yeah, so in those cases, you may not have revenue forecasted at all. It's okay to show that you have a lot of investment and a lot of, you would call them losses, but it's really you're spending in R&D. And so most companies who are in this phase, they're not going to have revenue. And it's expected that you wouldn't have revenue because you're most likely going to maybe be acquired. And that might be part of your fundraising strategy is telling investors what your exit plans are, that you're looking at acquisition, or you're maybe in the future, maybe you might license. So maybe you might have a forecast really far down the road of what that might look like, but it's okay to have forecasts just based off of your spend for your R&D, but really showing the value that you're creating as you're spending. And so if you are going to be in clinical trials at the end of the fundraise, or this fundraise is to get you into clinical trials or into phase 2, that's what you want to show and show your spending towards that, because it's really then the value that you're creating.
Yeah, it's pretty common for life science companies to, essentially not have revenue just because it's such a, long journey, depending upon the, the sector. We had a client IPO when they were still pre-revenue.
Mm-hmm.
Thank you.
Maylene and James, one more question, if you don't mind. What do you do when you've got multiple investors who see your pro forma with, different assumptions and fundamentally different assumptions? Do you have to kind of re-socialize across the other investors of this is our new date or this is the new level of fund, whatever that assumption is? I'm confused as we get questions from people that sort of contradict what's our responsibility to the other investor of like baselining to maybe some of these new assumptions we're operating towards.
You mean,
Yeah, so
go ahead, Maylene.
okay, so this happens quite commonly because as you're fundraising, your company is just changing. It's taking different direction, and the timing of when you talk to different investors just happens at different times of that development for your company. And so usually, if you're meeting with an investor that maybe you met with 2 months ago, but since then you met with another investor and you have a new version, you'll want to do an update with this investor you met with 2 months ago. If you're still going down that route to a potential term sheet, to give them an update on any major assumptions that may have changed with your company or new strategy that that might affect the runway or what your development timeline looks like. So you'll definitely want to do an update and let them know what's changed. Does that help answer your question?
It does. I think, again, for us, because we're kind of commercial ready, we get different levels of pressure of like how fast should we expand and what's the realistic adoption rate and things like that. And we don't have a ton of data now to support it. So it's a lot of opinions and a lot of things like, well, our other client does this. And we're just trying to navigate that dance without signing up for too much, but also showing some flexibility to, get the cash.
Yeah, and it honestly could be different scenarios depending on who invests with you, because they may have a different philosophy. And so you may not have to be as aggressive with this investor versus another. So I think it's okay to have different scenarios out there. And just being clear with, if you go with this investor, this is what the strategy would be, because this is what the relationship might look like.
Yeah, thank you.
Joey, did you have some quick input on that one?
No, and I think it really varies. I mean, yes, I did, obviously, because I put something in chat.
Yep.
I was just going to say, if you talk to an investor 2 months ago and they're interested and they're doing this, or they're in due diligence, and you update a pro forma because you've got new data or you feel more confident about something, it's a great reason to go back to them to re-engage and say, hey, by the way, we've got a new pro forma version. Love to talk to you about what we've done, how we've sharpened our sword on this kind of thing, and so on and so forth. So any excuse to ping people to find out, are they actually in, or if they've left the building.
Yeah, it's a really good point, because sometimes investors, they'll tell you, I really love the technology, but we'd really love to see you in clinic before we invest. And so maybe you're finally getting to that point, and so you want to circle back to them to let them know that we have the data to show we can do this.
Yeah, that's the famous, very, very popular line, we need more data. So cool. Anything else before we jump into the next one here? All right. So Mylene will pick it up with talking about pitch deck elements.
All right. Okay, so we've talked about the pro forma, what you're going to do with this, and really when you're fundraising, the key thing that investors are initially going to see is your pitch presentation. And ideally in your presentation, you'll have a slide or two on your ask and your finances. And so I have some items here to consider. So make sure you highlight, what is the ask? How much you're asking? How much money are you raising? What round is this? Is it a seed, Series A? Are you raising safes, convertible notes? And then you'll also want to highlight key milestones that the investor would be funding, timeline, so they can see value inflection points. Try to summarize what your use of funds will be. So you don't have to be in the level of detail of saying I'm using it to buy insurance and this, but really just high level of the G&A costs, R&D costs, but really more specifically project costs that you'll be using the funding for. And then also runway, when you potentially might run out of money, when you might need to fundraise again. These are all key highlights to have on a slide. So when you're also creating your pitch deck in the financial slides, you want to tailor this to the audience that you're presenting to. And so we talked about this a little bit in the Q&A, but if you're talking to a strategic, maybe they're really focused on a certain type of platform that you're developing, versus a VC, they might be more interested in something else. And so you have to really find alignment and get to know the investor to see what is it that is really of interest to them, that you think we should highlight on the slide. And so the more you can find out about your audience ahead of time, the easier it is to put together the slide and kind of highlight these key things for them. So I have an example of what you could do for a pitch deck slide. This one's a little busier. You could definitely break this out into a couple slides, but for the presentation, I wanted to have it all on one slide. I've had companies use this particular slide also, and it's gone over really well when you're presenting a lot of moving pieces and you have a lot of projects. The format up here is there's milestones. So this is highlighting the different projects the company is going to be utilizing funding for, and the timeline. Up here it shows what round this is. This is a Series A for 25 billion. You can even highlight what the key investment opportunity is. Down here, it's showing use of funds. And so at the bottom, here is actual timeline of dates. So this is really simplified, just showing annual, but you could do something where it's just by quarter, or if you wanted to do by year, you could do it this way. But this timeline actually aligns with the use of funds. So this is 1 year, this blue is a second year, the purple is another year, the peach is another year, and then these milestones actually line up. So as you're talking the investor through, you could highlight that you're currently raising a Series A of 25 million. 2 years ago, you raised a 5 million round. You were able to complete this milestone, and these are the great achievements that the company has had with the 25 billion. You're looking to address these great achievements, and you should be in clinic by this time, and here's the cost that you're spending on. And so this is a really nice way to pull everything together. And so
And-
with that,
Oh, could
oh,
you go back to that? And just for fun, we built a little, for anyone that's paying really close attention, we built a little flaw into it to see if anyone could spot it. Any quick guesses? I know we were presenting a lot in a short period. I'll just point it out just to keep us rolling. It looks like we ran out of funds. If you look at where the funds are before the Series A funding, we ran out of funds before we got our Series A funding. And so, often you want to plan a little bit, cash wise, ideally you'd be planning a little bit beyond the milestones or sorry, beyond the funding that's needed. Quite often companies can be out of gas by the time they get their funding, but you get less you get less leverage when they know you're really needing it. So anyway, little Easter egg in there. So, all right, keep going, Mylene.
okay. Well, I'm going to turn it over back to you, James, to talk about how to make it all come together.
All right. So just to kind of go back to the macro again, maybe pop ahead, Mylene. So kind of in the bigger picture, in terms of making it all together, you want to understand, it's a little bit of there's a lot of different elements you need to consider as you're moving along the journey. Right at the beginning, upper right, you'll see that there's a lot of issues to consider with the business setup as you're moving forward, and then you move into needing to address the quite often there's government grants and contracts that we've also touched on. There's also the core, accounting, cash flow management, which include, the core accounting, making sure you get R&D tax credits, tax prep, and compliance matters, as well as getting, if you have audits, making sure you've got those covered, having fractional CFO, the budgeting, the forecasting, the planning going on there. And then as you move around, positioning to capital, you have various we haven't touched on, it's kind of beyond the scope here, but, making, as you're getting ready for due diligence, having your cap tables ready, cap tables are the equity, the ownership of the companies, whether it's investors or whether it's the, founders or it's stock options, the investor ready pro formas that we talked about. Another one is, we have a subscription to PitchBook that we use for our clients for, provide like pre-market insights in terms of, I think Innosphere Good Chance has access to that too, but basically giving you insight into valuations, who's funding in your space, who are the competitors, what are they, what are their valuations and so forth. There's also moving along, I touch on the, CEO, CFO support. I don't have it here, but we've developed some real-time dashboards. So, we can see what's going on as we're moving along. Then you move into due diligence and you have, you have your data rooms and you want to be, it's a process, as soon as you get, done with funding, you're often moving towards the next one after you have one day of rest. And you kind of get all that ready. And, it's kind of a growing process that you're building on as you're moving through different funding rounds. You also, as you move towards an operational state and have investors, you also want to be preparing for your board meetings and communications. And then as you're approaching, you might be approaching commercialization or exit, whether it's, an acquisition by a strategic or an IPO. But, just wanted to lay this slide out because it really kind of covers the macro of all the, the accounting, finance, biz ops, matters that you want to be thinking about as you're moving along. It doesn't mean you're going to address everything in-house. It's important to kind of consider all of the various key elements as you're moving forward. So to move into the, kind of the next angle of how you do it, in terms of the making it all come together, you also have to consider, the people element of the equation. You know, won't get into this, but in a nutshell, you have to consider, you know, the systems you put together. We talked about, you know, I kind of think of it as like a, you know, kind of a four-legged stool. You have, you know, you have the people, you have the various solutions that you're using, you have the policies, procedures, as well as integrations to make it all come together. But essentially, you're developing a, you know, an ecosystem that involves people, systems, and processes to make sure it all comes together. And also, you know, you're also, you know, interfacing with your vendors, interfacing with your employees, interfacing with your customers, and you want to make sure it's all very clean, you know, and is efficient, but, you know, not overbuilding more than you need in terms of, you know, technology and or people for that matter. And the other is, yeah, trying to keep it simple, but, you know, have it be scalable as you can move up to the next phase. But the goal here is to create a system that meets your needs. If you have grant accounting, for example, you may have different needs. We sometimes, when clients get into government contracts, we sometimes move them into ERP systems. The other is it'll, you know, the right ops ecosystem allows you to operate your business efficiently, as well as, you know, most importantly, it's going to give you feedback so you get business intelligence to be able to run your business effectively. To touch on the people elements of things, there's a, you know, there's a lot that could be discussed here. This is going to be super high level, but essentially these are the really common roles that have to be filled with, you know, accounting, you know, with a life science organization. So these titles are here, but the thing I really want to emphasize, these are roles. These may be very fractional, so you don't feel you have to go out and fill all these roles, obviously. But yeah, the bookkeeper's office is addressing a lot of transactional elements. The controller level is often overseeing a lot of the, you know, kind of the overall financial statements roles, helping with audits, possibly. The CFO is often helping with the overall strategy, helping make, you know, provide strategic direction, you know, financial forecasting, also maybe helping with connecting with the board, you know, providing, you know, good insights and information to the CEO, and also maybe helping with some of the funding, the fundraising and investor relations, or even commercialization. You know, HR, various levels depending upon the need of the company. You know, the HR basically, yeah, helping with recruiting, getting, you know, kind of culture building, etc. An often overlooked role is some sort of, there's all sorts of, you know, office admin, office manager, ops manager. It's often one of the earlier roles that's good to fill. You know, covering a lot of different, you know, elements to free up, you know, whoever it is that, you know, the C-level team, the, you know, the researchers, you know, etc., to be able to really focus on what they're doing, also just addressing, helping work with, you know, various parties out there. And then there's also the CEO. And one of the, you know, really typically, I mentioned, you know, the CEO is often, you know, in addition to kind of working on forecasting and strategy, is often working on securing funding. And that's often, you know, in life science, the CEO is often tied in with doing the research. So it's a tough role to fill, you know, filling all those hats, but that's often, you know, what has to happen. But, you know, as I mentioned, it's filling these roles, but I mention them not because you have to fill them all, but you want to consider, are we considering all the roles we need to consider here? And then there's a few more different types of roles, and these are kind of tied in with biz ops, so I thought I'd mention them. But, you know, common role with companies that have manufacturing and supply chains as a COO. We work with a fair amount of COOs with, you know, our clients that are having more complexity going internally in terms of what they're working on. You know, if it's heavy FDA process, you know, you got a regulatory affair person that knows the FDA process. So it's really easy to get bottlenecked if you don't understand how to approach, you know, the regulatory process. There's obviously legal counsel. They're helping with formation. They're helping on contracts. equity financing, IP, and so forth. And then often there's project managers. And to kind of pull that all together at a higher level, in terms of how you typically are addressing it early stage. Very frequently, the bookkeeping and, bookkeeping, controller, CFO, very, very frequently is being addressed on an outsourced basis. Sometimes there's people who have, bookkeeping / admin / ops person internally doing some transactional work. The CFO role is sometimes there's a few answers to this. If it's going to be really heavy with connecting with clients and customers, and there's a lot going on in terms of reforecasting, commercialization, it can make sense to have that person in-house. But more typically than not, early stage, the CFO is working on a fractional basis outside of the company. And then in terms of HR, you can often get fractional resources here. Sometimes it's often a hybrid role with an ops person. Sometimes some accounting people are addressing the HR elements. The admin assistant can also be fractional, but it is often it helps to have that person in-house. Same, office manager quite often is in-house, as well as the CEO, obviously. Regulatory affairs, and also, is typically external, is generally a fractional person until there's a certain scale. Legal is almost always external because of all the specific areas I mentioned. M&A is very different than IP, which is very different than contracts. And there's, specialists usually work on that, and they're also, it's very expensive. And project management's usually in-house. And then also, in terms of how we address it, we're generally addressing all the, the bookkeeping, controller, fractional CFO, unless it's heavily involved in, getting on the road for fundraising and so forth, and heavily investor relations, et cetera, as well as addressing, a lot of the HR elements, and so forth. So, and then a couple tips, to consider, is, I mentioned it before, but really consider how all the various roles are going to be addressed. It's really easy for us, it's kind of a human nature to kind of go to our strengths and kind of somewhat ignore areas that are the less comfortable. But particularly if you're in that, CEO role, you really got to consider how all the elements are going to be addressed over time. It doesn't mean you fully address everything like you're a huge company, but and then another one is to look for people with appropriate industry expertise. There's another, also really carefully consider, employees versus contractors, as well as full-time, I guess, versus fractional, because it's really easy to, there's a lot of differences that people, there's a lot of extra costs with employees, for example, but, you may get more connection and so forth. So consider that. Another one is just, we often see companies really letting their compliance and HR matters really slip, and it can kind of bite them. So that this comes down to anywhere from the compliance to the, the employment agreements and those types of things. So really keep up on those types of matters. The other, make sure you get the, expertise when you need it. There's a lot of ways to get it, whether it's just using your mentors within Innosphere, or, or working with other people fractionally. And then another one is always be planning for the next stage, because you have to kind of think of it as dual tasking. You're working on what you're doing, and you're also moving towards that next stage. So with that said, let's jump to the next one, Mylene. So anyway, we've done a little bit of a world tour here of accounting and finance for early stage finance. We've covered positioning for capital, at a high level, financial statements 101, all of those elements, cash versus accrual, when to switch, all the GAAP versus SBI or government grants. We've covered the cost proposal basics or SBIR, the investor ready pro formas, how to approach those. pitch book elements, as well as you know, a quick touch on how to make it all come together. And let's see here, a couple other quick slides just so you know, who we are and what we do. We just, we look to address all these various elements, that I mentioned these all at the beginning, so I won't go into those, but, it's also touching on a lot of the areas you have to address, for accounting and finance. And then, last slide I'll mention is just kind of, it helps to illustrate, what you might look for, whether it's us or someone else. We're kind of at the base level, the transactional level, we're fractionally addressing all those transactional elements, bringing in the ecosystem, addressing the, controller level fractionally, whether it's just the core accounting or whether it's dealing with DCAA or GAAP accounting or audits, et cetera. And it's also fractionally coming in at the CFO level to help plan for, forecasting and investment and moving forward and in boards, et cetera. So with that said, we're going to jump into our final Q&A session. And we made up a little time there. So we have a few more minutes, and glad to answer some more questions. Let's see, I think there's one, Chris. When you say human resources, do you mean payroll benefits? Yeah. So Lisa said, when you say HR, do you help with payroll and benefits? And so, yeah, let me just break down the whole realm of HR and payroll and benefits. So we regularly address with payroll, as well as all the job costing or the cost allocations and so forth. We regularly address that, as well as all the elements that go into bringing employees on board, and making sure that that everything's compliant with labor laws. And we also work with our clients to bring in, help them quickly move through what benefits are appropriate, the policies they may want to set up for their business. And there's other elements of HR that get a lot more in depth. They may go into help, anywhere from team building to building a culture to, dealing with, maybe deep, I don't know, team issues and so forth. So sometimes if it gets really deep there, we're sometimes bringing in a third party that may specialize in a certain realm. So there is that realm between, the ongoing just hiring, anywhere we help issue and retire stock options as part of that whole process. But we call it HR light, but there is a place for people that are, kind of building a really in-depth handbook, or in some of those areas where we work, we have some great parties we work with that on that front. Any other questions out there I can answer? No one wants to talk about cash and accrual again, or anything exciting like that? All right, I will have a question for Mylene. So Mylene, what are some of the things as we're seeing companies early stage? What are some of the things we see companies, kind of missing, or just kind of not putting enough emphasis on as their, early stage life science companies?
I think early stage, because I've sat through different pitches that are early stage. In the pitch decks themselves, I oftentimes see the finance slide missing altogether. So it's common, but investors are looking for it. And so even if you don't have a full-blown forecast, it's important to at least spend some time to even put a rudimentary breakdown of your costs. So you have your total of how much things will be to get to your milestone, and at least have a clear ask of what you're asking for, and a timeline, a runway, and how much it's going to cost to complete that milestone. But altogether, I see that slide missing quite often in pitch decks early on.
Yep. Yeah, and one thing, a little bit unrelated, but it's a key decision point a lot of companies make. Is like, are you trying to be an investable company? You know, in other words, some companies, some companies do really well by just really completely focusing on non-dilutive funding. And so they're trying to keep their equity, and you have to generally move slower because the money isn't as significant, but it can allow you to keep more control. But it also, the flip side of that is it can make you look less investable, because investors always are asking, they want to move and get their money out. And one question they have, if it's kind of they start viewing it as a lifestyle business, they're going to wonder, are they ever going to get this out? Do they just want to do non-dilutive funding for 20 years? And, my grandchildren might get it, but I won't. And so, yeah, trying to think of that role between, getting outside funding that's going to maybe let you move faster versus the non-dilutive, which can allow you to have control. It also may allow you to get further down the road, increase your value, and, et cetera, de-risk it, get data, et cetera. Joey, or Kevin, what do you guys often see? You guys see a ton of companies. You often are seeing, kind of, areas where companies really have challenges, and anything's come to mind of, commonalities that you see that are worth, kind of early stage companies paying attention to?
I think you covered a lot of it today in my view, which is a lot of companies really don't understand the costs associated with what it is that they need to accomplish when they go out. And so they run out of money because their ask is insufficient. And in the pitch deck, I think sometimes I do see companies who don't put in the ask and then break it down. And it's like, why are you here then? So I think you covered it really, everything today in terms of that. But yeah, I think companies typically do ask for too little. They don't actually think through what it is they need.
Any adds to that, Kevin?
Yeah, I think related to what Joey's saying, I see people kind of plan to the last penny before they really get their fundraising strategy up and going. And I think as a audit judge, the other thing I see quite often is people include something in their ask that they don't include it all in their financials. Which always looks a little bit odd if you're saying I'm asking for this bolus of money to do R&D, and the R&D line doesn't change.
Yeah, another one, a lot of people have heard of CX, client experience, and I would, the other thing I think a lot of people forget is IX, investor experience. And just people get so caught up in presenting what, they're presenting the science, this, that, but think about it from the investor's point of view. They're looking to get a return. They're looking for something that's different. They're looking to de-risk a company that's going to, be able to move down the road. It has the team. You're trying to really think of that audience out there as you're building all of this, so you can be a fundable company. And if you just ignore that and get lost in your science and have holes and, haven't answered the questions, it's going to prolong the process. And I guess, kind of a corollary to that is, start your investor conversations early. It's very much a relationship. Start going to these events where you can start having these conversations with investors. Don't wait until, hey, I need money now. Say, hey, I'm early, and wanting to have a kind of initial discussion. Would love your input on my direction and so forth. And a lot of investors are willing to have that, that casual discussion and get to know you early, provide some casual feedback, and it helps build the relationship, because ultimately, you know, they're investing not just in the company, they're investing in the team and the people. And, you know, just like relationships everywhere, it helps to, you know, helps to have some icebreakers, you know, to be able to get there. So. Let's see. There's one question, do you charge by the hour, by the project? So generally what we're doing is we're working with clients on an ongoing basis. And so what we do is right up front, we have an initial meeting. And then if it makes sense for both of us in terms of what, you know, in terms of being a good fit, then we have an initial assessment process. And so we provide an NDA, and we gather some data from our clients to understand what their needs are in more depth. We don't charge for the initial assessment process, but then after that, then what we do is, in terms of a next step, we present a vision forward of what we think, you know, what we think the plan would be, as well as, you know, associated costs. So we don't work on an hourly basis. You know, we let our clients know up front, we're going to do this on this frequency, and this is going to be the cost for it. If things change, so be it. They change, and, you know, we'll add a special project if we need to. We'll increase or decrease scope as needed. But the goal here is to find alignment over time. So, you know, the other thing I'll say is we will share a number of, you know, the deck and a number of different resources, you know, kind of templates that, and, you know, afterwards, so you'll have that information. And we're also glad if someone, you know, has a kind of wanted to have a follow-up discussion, just, you know, reach out to us, and we can have a, you know, quick follow-on discussion related to, you know, your kind of specific situation that, you know, that may have come up in the, you know, discussion here.
James,
Right.
it's Lisa. I'd like to add to what you were just saying, and I'm
Uh-huh.
not being paid for this.
All right.
You know, it's hard for startup companies to think about, how do I spend money that I don't have on this valuable service? And, you know, maybe the question should be, how much time will you save when you do spend this project fee? How much guidance will you get? How much, how quickly you can get to a point where you could speak with investors and maintain a flowing relationship with them, not having to wait for 2 months or 3 months to get back to them. You know, it's sometimes hard to think about the spend, but it's a very, very valuable one. So just wanted to say that.
Appreciate that,
Especially-
Lisa. Thank you.
You're welcome.
And you're not
Maylene.
paid to say that.
And I know I'm not, and especially with you, Maylene. So, James, but you, Undy.
So, but yeah, I mean, that's the other, yeah, we're addressing what we're doing, but we're also we're helping our clients move forward is the real goal in the big picture here. So we do that in a lot of ways. And yeah, on our website, we have, I think, 16 video testimonials from clients talking about how we help them in different ways. And a lot of the ways we help them aren't even, you know, things they're citing aren't even in our scope. They're just, you know, connections and, you know, funding opportunities, you know, intros, et cetera.
Excellent. Well, thank you, James and Mylene. You
All right.
covered a ton of ground today. Super
Yes.
valuable
You're
stuff.
welcome.
You know, it ties into an area that when we assess the companies across the board, we're a little softer on. So it's good to get into this level of detail and kind of help people understand what they need to know and where they might need some assistance. So really appreciate you joining us today and being part of the program. Thank you very much.
Yeah, no, appreciate it, Kevin. Yeah, and we also, you know, we just have huge respect for what Innosphere is doing, and just in terms of helping the life science community between, you know, essentially they built what they do around, you know, the innovation companies, you know, having the funds out there, having these accelerator programs, having lab space, having, you know, awesome mentors. It's yeah, it's kind of a pleasure to work with you guys. And yeah, wish everyone out there, best of luck as they move forward. So, all right. We'll see you guys around. If you guys
Thanks
see
so
us at
much.
events and so forth, like the Fall Investor Conference or something, definitely stay high. Mylene and I will be there, or JPM or Bio or what have you. So,
Excellent.
all right. See ya. All
All
right.
right.
Bye-bye.
Thank you.
All right. Cheers.
Cheers. All right. We have one more quick slide to review, and then we will wrap up. So let me make sure I can find my one more slide here. It is. All right. Okay, so just a few action items following up from today's workshop and where we're going next. So what we'd like you to do is work with your client directors. Obviously, you can talk about and review your financials and see where you're at after today. Use this to kind of refine your pitch deck. We'll be continuing to work on that. We'll have another session coming up with Cindy Skalicki, I think in a week. I think it's a week from today, lunch and learn. So it'll be a noon to 1 Mountain Time program. Another action assignment is we're right at the midway point of the program today, believe it or not. So we want you to update your company assessments with your client directors. So the way I'd recommend you do that is an upcoming one-on-one, pull your previous assessment up, kind of talk through where you were on the definitions and see where you've moved and where you still want to focus some work. So I think you see in the company assessments, finances were one of the earliest, earlier stage development areas. So it'll be interesting to see kind of where you're moving there. For the next mastermind session, we want you to complete that ask worksheet, which is in the Slack channel, and share it with your mastermind, your client director and your mastermind host prior to the next meeting. So we want to kind of get in the routine of sharing in advance so people can think about what your ask was. We'll also be sharing these in advance with your peers and in the future, your Pioneer Council members. So we're really happy with the application process for the Pioneer Councils. We currently have 22 people who have raised their hands to be mentors in the program. And we have a nice spread across their disciplines. So I think each group is going to get some, really great feedback there. And then for one more thing on the mastermind, make sure you prioritizing your attendance for that session. That's one of the more important parts of the program. If a conflict arises, make sure you inform both your client director and your mastermind host in advance, so they can understand who's going to be there and who's not. Particularly when we get the Pioneer Council folks in, we want to make sure we're using their time really well. So the mastermind councils I touched about a little bit. Each mastermind group will have their own dedicated group of Pioneer Council mentors. We'll be asking them to participate in one of your mastermind sessions, probably beginning with session number 3. They'll be reviewing your asks after each session. And they'll be available for a 30-minute virtual coffee with each of you, and then they'll participate in a pitch review toward the end of the program. So as always, we always encourage you to go in and check in on Slack. We are kind of tagging investment and news of interest to each of you specifically. And that's also a great place if you have an ask in between sessions that you can pop it in to see if you can help one another. So with that, our next workshop is a reimbursement boot camp, and that will be on Tuesday, August 20th, in the same time slot, 8:15 to 12:15 Mountain Time, and that'll be led by Patty Telgener. So that's a great session. Even if your product is not one that requires boot camp, a lot of her discussion is about how do you represent your value. And that is super important as we kind of lead forward into launching life science solutions into the marketplace.
Hey, Kevin, when you say, I think you meant each company who doesn't need reimbursement, not boot camp.
Was
Correct?
that what I said?
Yeah, you said boot camp if your company doesn't require boot camp. And
Oh.
so
Yes, I said that completely backwards. So
I just want to make sure give clarification.
yes,
Every company needs boot camp all the time.
right. So some of you won't require reimbursement, but you will require needing to describe how you generate value and utility in the marketplace. So that's probably the clearer way to say it. So thanks for catching that, Jolie. So with that is our session for today. And I just want to double check. Ravi, you were recording, correct?
Yes,
Excellent.
I was.
Okay. Just wanted to make sure because I did see someone else record just in case we didn't catch it. So dawned to me it wasn't clear up front if you or I were recording. So thank you. All right, with that, we are all wrapped up for today. Thanks for joining.